What do you think of when you think of Southeast Asia? The region's natural beauty? Its rainforests and islands. A cup of Java coffee. Your honeymoon in Phuket? Its rice paddies and terraces. Your favorite Thai food? The human tragedy of geopolitics. The Asian financial crisis in 1997? Or perhaps your best friend from college? Or, if you are from here, home. Southeast Asia is all these things and much, much more. For many decades, Asia's best-kept secret, Southeast Asia is today both a demographic and economic powerhouse. It's 689 million people across 11 nations, almost 9% of the world's population, are forecast to generate $3.9 trillion of GDP in 2023. That's grown 8% a year in nominal dollars since 2000, one of the fastest economic growth rates in the world. Southeast Asia is home to some of the world's largest cities, from Jakarta in Indonesia, by some accounts the world's second largest urban agglomeration with 34 million people, to Manila in the Philippines with 25 million, to Bangkok in Thailand with 18 million, Ho Chi Minh City in Vietnam, Kuala Lumpur in Malaysia, and the region's commercial hub, Singapore, one of the most modern countries in the world. My name is Nancy Hungerford, and it is my pleasure to take you on a guided, data-driven tour of Southeast Asia, a data documentary, if you will, along with the team at Asia Partners, a Southeast Asia-focused technology investment firm. During my 10-year career as a journalist with CNBC, several years of which I spent anchoring Squawk Box Asia and Street Signs from Singapore, I had a front-row seat to Southeast Asia's extraordinary rise. From covering the IMF meetings in Bali to the APEC summit in Vietnam, I also had the pleasure of hosting CNBC's Asia coverage from the World Economic Forum in Davos. But Southeast Asia's story is still only half written, and I personally think its best years are still to come. There are so many questions worth asking. What role should Southeast Asia play in a global investor portfolio? What are the risks? How is technology creating a new set of opportunities? What are the similarities and also key differences from other emerging markets that have already climbed the tech stack? How can we identify the best and brightest entrepreneurs of the next decade who will lead the next generation of innovation? Where are we in the global macro cycle? And when will IPOs, including from Southeast Asia, return? How is Southeast Asia unique in ways that our traditional ways of thinking might lead us astray? For example, is the traditional dichotomy of EM and DM the right way to look at Southeast Asia and its place in the world? Is the way in which technology is creating shareholder value unique, as well as different than the Western template? These are just some of the questions that we hope to help you answer through this film. And we'll do that not just with opinions, although the people I'll interview will share a few along the way, but especially with data. That's why we call this a data documentary. Our hope is that the ideas and data we share will help you form your own views, and perhaps even help inform the decisions you'll make in the changing world in the 2020s. With that, let's jump in. I've known Asia Partners for several years, and I had Nick Nash, one of the co-founders of the firm, on Squawk Box a few years ago. Well, Nick has lived in Singapore with his family since 2011 and hasn't just had a front row seat to Southeast Asia's tech ecosystem, he's been right on the court. From 2014 to 2018, he was the group president of Sea Limited, which is today Southeast Asia's largest publicly traded internet company, with a $27 billion market cap in January of 2023. Nick led Sea's landmark IPO on the New York Stock Exchange in 2017, which raised just under $1 billion in capital for the company. Now, despite all the ups and downs of the markets in the past few years, Sea has been one of the world's best performing tech IPOs of the past 6 years. And Sea alumni are now ubiquitous across Southeast Asia, founding and leading new companies. Before joining C, Nick had spent a decade at General Atlantic, one of the world's largest private equity firms, where he co-founded and then ran their Singapore office. A little more than a year after C's IPO, Nick co-founded Asia Partners to return to his investing roots and, in his words, help to support the next generation of C's across the region. Nick, let's get into it. As an investor, what is the case for Southeast Asia?
That's exactly the question General Atlantic asked me to figure out when they sent me here from New York back in 2011. The last 12 years living here have really helped for me to bring this question into sharper focus. Let's start with the region's track record. 2022 was a very challenging year for public market equities. Almost all of the world's stock markets suffered losses, but a handful managed to preserve value or even increase. Thailand, the second largest economy in Southeast Asia, was one of them. Its index actually grew 2% in US dollar terms. Singapore was flat, which was a real accomplishment in a year like 2022, and Indonesia fell only 4% in US dollar terms. In contrast, the Bloomberg index for mid and large cap US stocks was down 21% in 2022. In fact, 5 out of the 6 major economies of Southeast Asia outperformed the US in 22 in dollar terms. It's worth mentioning that Vietnam did not. In fact, it was among the world's worst performing markets that year, and that's despite very strong GDP growth.
But that was a one-off. After all, that's just a single year we're talking about.
You're absolutely right. It's important to take a longer perspective. If you go back to the beginning of the century, the year 2000, and roll forward equity returns from then through 2022, Southeast Asia again does fairly well. On the left-hand side, you can see the absolute IRR, or annual returns, by country over the past 22 years. Thailand and Indonesia, which are the 2 largest economies in our region, did exceptionally well. And this is again in US dollar terms. They each outperformed the US markets by several hundred basis points. The Philippines also had a strong showing, outperforming the US by over 100 basis points. Those are on the positive side of the ledger. To be fair and balanced, it's worth pointing out that Singapore, Vietnam, and Malaysia each underperformed US equities by between 100 and 150 basis points, though they did each have a positive return in absolute terms. That's an important topic my colleague Friska will shed some light on later in this film.
Okay, but returns by themselves, even if they're positive and better than the US market, only tell part of the story. If you're only getting, say, just 140 basis points above the US, which is essentially what the Philippines have yielded, why bother?
It's the right question. The key dimension we're still missing is considering diversification. Now, I'm not suggesting that you should invest in a market that has negative returns just because it isn't correlated with the US. But if you look at our market, a lot of the markets that have had positive alpha to the US markets also have fairly low correlations to the US markets. That's a good thing. We like to look at both of these data sets synthesized together, which is this chart. In an ideal world, you'd have a positive IRR, and ideally well above that of the US, which has been just below 5% for the past 22 years, and you'd have a low correlation to the US markets, meaning you would zig when America's stock market zags, so to speak. That means closer to the lower right-hand side of this chart, the green direction, and away from the upper left, which is the red direction. On that basis, Indonesia and Thailand again really shine. In fact, on this holistic basis, the entire region is actually quite interesting, assuming that the bulk of your existing portfolio is tilted towards US equities, as is the case for most of the world's largest institutional investors. The other interesting lens has been how Southeast Asia has handled the recent global surge in inflation. We'll talk more about it later on, but for now, let me share this. In a world which had challenging GDP growth and high inflation in 2022, the classic stagflation recipe of the 1970s, it's remarkable that 3 out of the 6 economies in Southeast Asia had real GDP growth higher than inflation. Almost all of the rest of the world fell into the red zone on this chart, with the opposite taking place. Inflation was higher than GDP growth.
Talking about inflation, though, brings up the perennial worry that investors have about emerging markets. That is the drag from FX. How do you think about that in your region?
We're always puzzled when folks look at FX changes in isolation from inflation. In our mind, they're sort of two sides of the same coin. If you have a higher inflation rate than the US, all else equal, and there often are balance of payments and trade surplus dynamics as well, you ought to have a parallel erosion in your FX rate versus the dollar. If we look at the last 2 decades, and just for a moment, since final year 22 numbers aren't in yet, let's look at 2000 to 2021. The US had 2.1% average inflation, and of course, the FX rate didn't change versus the dollar. It is the dollar. Now let's look at Singapore, which is about a third of the way down the chart. Singapore's inflation was actually lower at 1.3%, so it's not surprising that its currency actually appreciated against the dollar. The result was a 2.4% total net effect, which was actually slightly higher than US inflation, meaning in very practical terms, if you held the Singapore economy but measured yourself in US dollars, you were actually slightly ahead, which is what you see in the rightmost column. Let's look at another example, say Indonesia. Indonesia ran a much higher inflation rate versus the US over that period of time. So you'd expect to see its currency erode. It did. But on a net basis, you actually had a total of 5.4% in dollar terms, which was 3.2% higher than US inflation. It means that you actually got paid for holding the Indonesian economy when measured in US dollar terms, just like Singapore, but even more so. In fact, that dynamic obtains for all 6 of the major economies of Southeast Asia in varying degree, which you can see highlighted across the page in yellow. That's not necessarily common around the world. These dynamics actually worked against you in the UK, Hong Kong, and Japan, as you can see from the red bars at the far right. But they were a useful and quiet source of alpha for US-denominated investors in Southeast Asia over the past 20 or so years. Of course, there's no guarantee that will continue, but it's still very interesting to see.
But we did skip 2022, and that was such an important year.
Totally. I am very interested to see what the net effect of FX and inflation will be once we have the final numbers in. What we can say, looking at just one side of the coin, was that 5 out of our 6 economies did have FX depreciation versus the dollar. The Singapore dollar, consistent with 2000 to 21, actually appreciated versus the dollar, but the other 5 did not. This isn't to exculpate any of the currencies from depreciating, but if you look at how they did versus the euro's depreciation, 4 out of the 6 actually depreciated less against the US dollar than the euro. And needless to say, they all did much better than the yen, which lost 12% against the dollar in 2022. It was a great time to go on holiday in Japan if you had US dollars.
Understood, but this really has all been backward looking so far. So what about the future? What can you tell us?
Well, as more than one person has said, it's hard to make predictions, especially about the future. Why don't we start with what the IMF has to say? They don't always get it right, no one ever does, especially in a recession year, but it is an interesting starting point for conversation. We pay a lot more attention to nominal growth in US dollars because that's apples to apples with ultimate equity IRRs. And on that basis, in the past 5 years, China was the fastest growing economy in Asia, again in nominal dollars. Over the next 5 years, the IMF thinks it will fall a few notches down, with Vietnam and Indonesia each growing faster. And that's not to take away from the rest of Southeast Asia, all of which are forecasted to grow faster than the US, Germany, and Japan. That's a major change from the China centricity of the past decade. But needless to say, economic forecasts are just forecasts. What's a lot more dependable is demographics. Let me put it this way. The world has 29 countries with at least 50 million people. 6 of them have flat or shrinking populations over the next 5 years. Almost nothing can change that. What's very special about Southeast Asia is that out of the remaining 23 that are growing, we're home to 4 of them. And many of the others in the 23 are truly frontier markets and in some cases even arguably uninvestable. In contrast, the largest population countries in North Asia and East Asia, which have certainly gotten a lot of investor attention over the past 50 years, are all falling. That's happening already. It's happening now. What that means in practice is that Southeast Asia, and this includes some of the smaller countries, less than 50 million, although Malaysia's 34 million is more than all of Texas, is really driving Asia's population growth in the next 5 years. In fact, the IMF estimates that 3 out of our countries will have an even higher rate of population growth than even India, even though they're actually more affluent on a per capita basis. There are many ways you can take useful cuts out of demographic data to analyze them. And the one that we find particularly revealing is to look at just the number of 15 to 35-year-olds. That age band is very important for tech product adoption, and it's a leading indicator of the size of the workforce in the near future. On that basis, Japan, Korea, China, and Taiwan all peaked in the 1990s, not a few years ago, in the 1990s. India is expected to peak in 2026, in basically 3 years. Southeast Asia holds out the longest, with a peak in 2031. That says a lot about Asia's future in one chart. And if you unpack Southeast Asia's curve, you see a few interesting things. The ongoing demographic expansion is coming from the 2 largest countries by population, not just because they're big, but more importantly because they're still young. In contrast, Malaysia peaked in 2019, Singapore in 2016, Thailand back in 1995. The fact that the Philippines only peaks in terms of the number of 15 to 35-year-olds around 2055 is a hugely important fact. All of these underlying data points set the stage for what we think is one of the most interesting opportunities, the build out of a fully fleshed out tech ecosystem in our region, following in the footsteps of China, Korea, and Japan beforehand.
Back in 2019, when Asia Partners was just getting started, they published a study that made 8 very specific predictions on how Southeast Asia's tech ecosystem would evolve over the next decade, with measurable targets by 2029. That report has become an annual tradition, and each year the team looks back at those 8 predictions and holds themselves accountable to see how right or wrong they were. It has become one of the most popular sections of each year's report, 4 years running. Oliver Ripple is one of the co-founders of Asia Partners and has a very unique background. He's half German, half Korean, or a Kerman, as he likes to say. After 9 years with eBay across Europe, Korea, and Southeast Asia, he then became an executive at Naspers, one of the world's largest internet conglomerates, where he rose to become their global CEO of all business-to-consumer e-commerce investing. Oliver's investment in Flipkart on behalf of Naspers was one of the best tech trade sale exits in Asia's history, earning Naspers $1.6 billion of net gain in cash and a 29% IRR. Oliver, wonderful to be with you. Why did you make such specific predictions back in 2019? Isn't the old rule of thumb of management consulting that it's better to be directionally right than specifically wrong?
Well, that's why I'm not a consultant. All of us at a senior level at Asia Partners are what we call investor operators or operator investors. We've each done time in the trenches as operating executives at companies, and we've also each spent time as investors before founding the firm together. We have a lot of respect for startup founders who set a specific plan and then go hit those numbers. And we felt it was only appropriate that we put our own necks on the line with a forecast and then hold ourselves accountable each year, just like measuring actuals versus budget for a company.
Take us through the 8 predictions for 2029, one by one, if you will. You're about 4 years in, give or take a little, since 2019. So how have they turned out so far?
Well, we let you be the judge. Let's start with the first one, which was that Southeast Asia was entering what we called its golden age. That's not just a slogan, it's a very specific period of time when a country's GDP per capita is $4,000 to $8,000 per person in 2023 dollars. What you see on this page is something quite beautiful actually, not the chart itself, but what it stands for. This is the journey how Asia built its middle class, one country at a time. Japan was first out of the gates, going all the way back to the 19th century, followed by Korea, then China, and now us in Southeast Asia. You can see that Japan, Korea, and China each went through that formative zone of $4,000 to $8,000 per capita. Japan from 1955 to 66, Korea from 1979 to 89, and China from 2014 to 15. They are all well past the golden age now in terms of affluence. We are the only major part of Asia in it right now, at about $6,000 of GDP per capita, and will be there for several more years. India isn't there yet, but should get there by the early 2030s. You can set a reminder in your calendar. What's important about this zone, $4,000 to $8,000, is it's when really large technology companies go public. Or more precisely, it's when the companies that eventually become big first go public. Consider the following. China was in that zone from 2004 to 2015. A bunch of tech companies went public before then, and a lot have gone public since then. But if we look at the golden age years, plus or minus a few years, 59% of today's current tech market cap is from companies that went public during those years. That's $1.9 trillion of market cap. It's just staggering. And it's not just China. Look at Korea. It's a smaller country, so the data is more lumpy, but if we apply the same filter, 58% of Korea's current tech market cap originally went public in its golden age, plus or minus a few years. Japan hasn't been in its golden age for 2 generations, but you can still see the echo of its golden age in the 25% of its current tech market cap from companies that went public from its zone. As Euclid said, 2 points make a line. Here we have actually 3. And there's a lot of data to suggest that Southeast Asia, as the next region of Asia to go through the golden age affluence zone, could be next, which means that the companies that go public in the 2020s might do some very interesting things over time.
This is empirically interesting, but why does this happen?
It's like the old joke, it works in practice, but does it work in theory? There are probably many reasons, but we'd suggest 2. First, you see a dramatic rise in discretionary income as countries approach and then enter the golden age. If we use the gross savings rate as a percentage of GDP, you see that very clearly for China, Korea, and Japan. Second, there's some anecdotal evidence to suggest that after the golden age, things get more oligopolistic in terms of major incumbents that start to get bigger and bigger. You started to hear the BAT acronym for Baidu, Alibaba, Tencent in the 2010s. For example, as China was exiting its golden age. The second prediction we made was that there was a very specific type of technology business model which would work very well for startups in Southeast Asia, and that most of the successful startups from our region would adopt it. That's turned out to be correct. In fact, it's one of the core pillars of what we're looking for in our investment selection criteria. Imagine you had a bonsai tree with 3 branches. One branch would be most of the world's tech market cap. These are businesses with powerful network effects, and those network effects don't have a geographical limit. They're global. You know it's a category 1 on the bonsai tree when the Google of Thailand is Google and the Facebook of Indonesia is Facebook. These are very interesting companies, but they tend, by and large, to be launched out in the West. A fascinating and inspiring exception to that rule is, of course, ByteDance, and we hope that Asia will produce more over time. A second category is what we call the unique local winners, where the regulators have, for one reason or another, unleveled the playing field. We tend to avoid those kind of companies in Southeast Asia, and thankfully there aren't that many of them. Where we focus is on the third branch, and this is quite interesting. The mere existence of this third branch was arguably quite controversial, or at least underappreciated 10 or 15 years ago. That's where life experience really helps. I was part of eBay's adventure in China many years ago when we bought EachNet, which had 80% share of the country's e-commerce market, and got defeated by a little-known company from Hangzhou called, you guessed it, Alibaba. It wasn't that the government gave Alibaba an advantage per se. The company we bought already had 80% market share. It was that there was something inherently local about marketplace e-commerce that gave a local team with a keen sense of local consumer needs a decided advantage over time.
Is there just that one category 3 model, e-commerce?
We think there are several actually. The interesting thing is that often Cat3 bonsai models are actually invented in the West, but when they come to Asia, it's often the local girl or local boy that ends up dominating the category. Again, not because of regulatory help, but there's simply an advantage of being on the ground and very attuned to customer needs. We've seen this movie play out in e-commerce, certainly, but also in many other categories like online travel, games, education, cars, real estate, healthcare, ride sharing, and also marketing. Any internet category where there's something very local about the execution and you can't simply run it from an air-conditioned central business district building.
Okay, but the counterpoint here would be that these are niche markets versus, say, the Google global search franchise. How big can those Cat3 companies get?
Those were actually our third and fourth prediction. We predicted there would be at least 20 more billion-dollar value tech companies from Southeast Asia by 2029, and half would go public. You have to go back down memory lane to 2019 to remember how gutsy that prediction was. Only C had gone public, and it had a tough first year in the markets as a public company. There was a lot of talk about C being a one-off, a bit of a fluke, which is why we were delighted to see that it's not just 1 or 2, but 7 more tech companies have gone public in Southeast Asia at a $1 billion valuation or greater since our 2019 prediction. In fact, 2 of those were in 2022, which around the world was a tough year for IPOs. All it will take is for 3 more companies to go public in the next 6 years, and we'll be at our target of 10 more. But we think it will actually be more than that.
How did you pick the number 10 to begin with?
If you look at China's journey through the late 1990s and then its golden age and beyond systematically, there's a very interesting pattern that emerges. This chart has been a bit of a labor of love for us to put together. It shows you every tech IPO from China since the very beginning of tech IPOs in 1995. It was only in 1990 that the Shanghai exchange reopened and the Shenzhen exchange opened, and in 1993 that the first mainland company listed on the Hong Kong Stock Exchange. So 1995 was really very early on. We like to call this chart the periodic table, like in chemistry, and what you see on this chart are 4 waves of IPOs. First came the telecom infrastructure IPOs, starting in the mid-1990s. Then Web 1.0, which almost everywhere in the world is online ads, online games, and online travel. Then e-commerce, and finally online services like fintech and food delivery. This is intellectually interesting, but what's more powerful is to compare the chart for China with the equivalent chart for Southeast Asia. And what you see is that Southeast Asia's chart is only half written. There are plenty of rows where there isn't a single public company yet, but we know from the bonsai analogy that many of those rows are bonsai Cat3 models that should exist in every part of the world, built by local entrepreneurs with on-the-ground networks. Counting down those empty rows were the genesis of the prediction of 10 more IPOs, and it's exactly how we've been investing at Asia Partners. Our portfolio corresponds quite closely to those empty rows on the chart for Southeast Asia, almost like painting by number. We sincerely hope that many of them will become public companies in the not-so-distant future, putting new rectangles on the chart.
Now, you've mentioned you're already at 7 out of the 10, but what could still go wrong over the next 10 years?
Yeah, something we do worry about is the still underdeveloped equity research ecosystem in Southeast Asia. It's something to consider, and we hope that the investment banks will find a way to make this a priority. A simple search on LinkedIn suggests that Singapore has only 63 equity research analysts to cover newly public companies, versus 305 in Hong Kong. That infrastructure was carefully built up in Hong Kong to support China's IPOs over the past 30 years, and we need to build that up here as well.
It looks like you didn't get the next one quite as right, or am I being too harsh?
Well, the facts are the facts. We predicted there would be an additional 400 billion of market cap in tech by 2029. 4 years in, we are 15% of the way there, rather than the 40% of the way there. So we are behind schedule.
Where did the $400 billion number come from?
Back in 2019, Southeast Asia's total tech market cap as a percentage of GDP was just 2.2%. China was already at 16.6%, and that percentage had gone up over time to get to there. We felt there was a good chance that Southeast Asia would be there at 16 to 17% by 2029, which meant that without even taking into account an increase in GDP over the next 10 years, we'd have an additional $426 billion of equity value. For the record, if you look back a year ago, we were well ahead of schedule, with C's market cap being a major driver of that. The biggest driver of the change has been the correction in C's share price since the late 2021. But with 6 years still to go, we are still cautiously optimistic that we'll hit and perhaps even exceed the target for 2029.
One of the biggest differences between Southeast Asia and, say, China is that Southeast Asia is multiple countries rather than just one. In fact, there are some people who say that Southeast Asia shouldn't even be called a region. It's more of just a grouping of countries that happen to be geographically between India, China, and Australia. What is your view?
That was the heart of our next prediction, and it's been on the mark. Every person who says that Southeast Asia isn't an addressable region has to confront the very relevant fact that C today, which is very intentionally regional in scope, is a $27 billion market cap company, and Grab, which is also intentionally regional, a $14 billion market cap company. And that's one of the single biggest changes in our region since I first began working here over 12 years ago. It is now possible, full stop, to build regional companies, especially in tech. There are multiple proof points of how to do this, but it's not easy and there is a very specific playbook for how to do it. It's helpful to start with what we call the chessboard, basically a summary of the key strengths and weaknesses of each of the 6 major economies in the region. Some have a lot of GDP, like Indonesia and Thailand. Others have population. Half have programmers in quantity and 2 have reasonably decent capital markets. But only 2 are good springboards for building a regional company. And interestingly, those are the 2 former British colonies, Singapore and Malaysia. Not surprisingly, they're also the 2 smallest among the 6 in population, which means they've been running out of a domestic market for a long time and have learned to expand abroad. The way this plays out is that there are 2 core strategies we see. Strategy 1, where you just focus on Indonesia, and Strategy 2, where you go regionally. We are constantly on the lookout to see if a viable Strategy 3, which could be a single country, Vietnam, Thailand or Philippines, will emerge, but it may still be a little early. The way in which you execute against Strategy 1 or Strategy 2 is very, very different. And therein is a source of competitive advantage, part and parcel of the bonsai Category 3 thesis. Take a look at this chart. On the right, you see 2 representative local subsidiaries of global tech companies, Microsoft and Tencent. See how close to half of their people are just in Singapore? That's a classic playbook for someone coming in from abroad, and it has its limitations. Now look at the Strategy 1 and Strategy 2 companies. They are much, much more local. The Strategy 1 companies have virtually all of their people on the ground in Indonesia. And even in Strategy 2, no more than 10 to 12% of their people are in Singapore. The rest are fanned out across the region, building the business at a local level. This page is sort of a textbook example of why there's a 3rd branch to the bonsai tree.
Why is Singapore the hub for Strategy 2?
Whenever you have a region of the world with multiple countries, it's often the case that one country and even one city becomes the hub for commerce. In Europe, it's clearly the UK, and within that London. In the Middle East, it's far and away Dubai. And in Southeast Asia, Singapore has long been the region's hub. What's quite impressive is that, quietly, Singapore has also become Asia's hub. If you look on LinkedIn for people with Asia Pacific, Asia or APAC in their job title, 25% of those people globally are based in Singapore. We like to say that Singapore is an overnight success that was 100 years in the making. If you take the long view, Singapore has steadily, patiently earned its success over time. It reached parity with the UK in 1993 in terms of GDP per capita, then in my home country of Germany in 1994, then Japan in 1997, and then the US not just a couple of years back, but 15 years ago. Part of why Singapore keeps rising is that it keeps reinventing itself. It's a long forgotten fact that Singapore used to be the hard drive capital of the world. Almost half of the world's hard drives came out of Singapore in the 1980s and 90s. Then it became a financial services and travel hub. Now it's an internet hub. It's actually very exciting to watch. And the other thing to watch is that Singapore is becoming a hub for global family offices. China's rise is part of this, but so is the rule of law and stability that Singapore offers. We think there's a very good chance that the world's next BlackRock might very well be built here in Singapore.
Many of those family offices from China are for successful entrepreneurs who were, not all that long ago, startup founders themselves. And many of those China founders came out of its first generation of tech platforms. So are you seeing that dynamic in Southeast Asia, a sort of PayPal mafia, so to speak?
Yeah, very much so. That was the core of our next prediction. This one is also better than we thought it would be, but we can't take too much credit. We probably undersampled the pool of academy companies in the first time around in 2019.
Academy companies?
There was a great article in the Wall Street Journal in January 2023 about how half of the head coaches in the US NFL are the prodigies of just 2 other coaches. The same thing is true in Southeast Asia. A lot of great founders come out of a handful of talent factories, which we called the academy companies. Look at this back in 2019. The 10 companies on this page had already produced about 1,200 startup founders, which is what you get when you add up the rightmost column. Rolling this forward and looking at just those 10 academies again, the number is now 2,700. That's partly because now we look at both founders and CEOs. After all, Tom Watson didn't found IBM, but he surely helped to build it, but also because of the passage of time. It's remarkable. But where we erred in 2019 was in limiting the academies to just 10. There are actually far more, including the telcos and even semiconductor companies like Intel. After all, until C, Grab and others, tech in Southeast Asia was largely 20th century tech companies. They produced a lot of alumni. If we look at the broader aperture, there are another 3,000 or so founders and CEOs they've recycled back into the ecosystem. This is very powerful.
What about founders coming to Southeast Asia from other parts of Asia?
That's another very powerful trend. Back to the periodic table and the Golden Age charts, China and Korea are 10 to 40 years ahead of us. There's a lot our region can learn from their entrepreneurs. And in parallel, India is just to our west and has a superb higher system of higher education. One of the things we've started tracking is how many alumni of the top 55 or so universities in China are now working in Southeast Asia's tech industry. Just based on LinkedIn profiles, it's at least 13,000 people. 557 of them are now founders or CEOs, and that number seems to be growing almost by the day. When we first went looking for this in November 2022, around Thanksgiving, it was just 536. Now it's 557, or 1 every 3 days. The same is true for graduates from India's top universities. There are over 9,000 of them here in the region's tech industry, and 490 are founders or CEOs. And ditto for Korea, my mother's home country. Over 6,000 graduates here, of which 240 are CEOs. It's particularly interesting to see how many have founded companies in Indonesia, almost 20%, which is 2x the ratio from China and 3x the ratio from India.
Interesting. Well, by my count, we're up to 7 predictions. So what was the final prediction?
The Series C-D gap. It was both a prediction that Southeast Asia was now investable for growth equity size checks, as opposed to just venture capital bite sizes, and a statement of fact, which was that there was an acute supply gap in the Series C-D band.
Did you get it right?
By and large, with the exception of 2021, when pretty much everything in the world was oversupplied with capital, almost every country, almost every industry, almost every stage, Southeast Asia was not an exception. But what we're seeing now is a dramatic pullback in capital supply, which we can quantify almost in real time, and that's bringing the Series C-D gap back as a prominent feature. To provide some context, think of venture capital and growth equity funding for tech companies as a continuum from seed all the way to IPO and beyond. In our part of the world, seed tends to be under $1 million, Series A and B between $1 to $20 million, and Series C and D between $20 to $100 million. There are exceptions, but that's a pretty good rule of thumb. The seed ecosystem is quite active, but hard to quantify. If we go one step up the ladder to Series A and B, what's evident is a very robust expansion in capital supply in recent years. From 2015 to 2022, our upstream brethren in the Series A and B community made over 1,300 investments. There were over 900 in just the past 4 years. 2022 was more than 3.5x 2015. Each way you look at it, this is a thriving segment on the continuum. Now let's keep climbing the ladder to Series C and D. There's a great database we subscribe to which lets us build up the actual amount of capital supplied in the $20 to $100 million size range, deal by deal, quarter by quarter over the past decade. What we do is add up all those deals in China and then index that to the total size of China's GDP at that moment in time. And then we do the same math for Southeast Asia's deals, recognizing that our GDP is of course smaller. This makes it an apples to apples comparison, not apples to Samsung.
Apples to Samsung. I like that. I could have used that in my news days.
What can I say? I'm half Korean. What that tells you is that for most of the past decade, there was a gap to China of about 3.6 basis points. That may not seem like much, but multiply it by $3 trillion of GDP in Southeast Asia, and it adds up. There was a brief period of time from late 2020 to mid-2022 when the entire world was oversupplied with capital. Southeast Asia and China were no exception, and there were even a few quarters where we indexed slightly higher. It's a key reason why we at Asia Partners paused on all new investments for about 12 months between mid-2021 and mid-2022, and we're fortunate that we did. And now, looking at Q4 2022, you can see that capital supply is in free fall. That's a very interesting dynamic for folks with dry powder.
Is China the right comparison or simply the only comparison?
Historically, because of the periodic table analysis and the fact that their golden age was just a few years ahead of ours, it was. But we also want to learn from other parts of Asia. We found that there's a gentle relationship between a country's GDP per capita and the amount of its growth equity capital for tech companies, the latter measured as a percent of GDP. You can see this with the progression of Southeast Asia in light blue, China in black, and Korea in dark blue. And you can see what an aberration 2021 and even the first half of 2022 was. And you can see how things have normalized again back in the second half of 2022 with capital supply again in free fall.
Why is India so high for where it is on the affluent scale?
It's a great mystery to us. It feels for us to be very oversupplied with capital. I remember that even only a few years ago, we estimated that the total addressable market of customers for us was perhaps no more than 60 million people out of a population today of 1.4 billion. That will grow as India enters the golden age in the early 2030s, but it can't happen overnight. That said, we do look at both China and India as a reference point and as a mathematical matter relevant to India's supply of capital over the past few years and China's supply of capital over the past few years, indexed to GDP, Southeast Asia is still undersupplied with Series C and D capital. We can look at this a few ways to get a precise handle on it. First, we can benchmark to China or to India. Once we have a point of reference with one of our neighbors, within Southeast Asia we can look at capital going to strategy 1 or strategy 2. That's the Indonesia-only strategy or the pan-regional strategy. We can look at the gap relative to the benchmark for Series A and B, Series C, Series D, and then beyond. And finally, we can look at this for the full year 2022, which includes the leftover exuberance of 2021, or just the final quarter of 2022, which is very different. This first chart looks at the under or oversupply relative to China, looking at Southeast Asia's full year 2022 versus the average in China over the last few years. The scale means that, pound for pound, the capital supply is equivalent to China. A thumbs up is from the investor perspective. That particular segment in Southeast Asia is undersupplied. And a thumbs down is also from the investor perspective. That particular segment in Southeast Asia is oversupplied. From the standpoint of a startup raising capital, the thumbs would flip. What you see is that, relative to China, there were a lot of red thumbs down across the region in full year 2022, largely because 2021's euphoria hadn't fully tapered down in the first half of the year. However, if we zoom into Q4 2022, it's a very different picture. A lot more green thumbs up, which is great news for growth equity LPs. Needless to say, if you benchmark to India, everything's a thumbs up everywhere. That's true regardless of whether we look at the full year or just the fourth quarter. So to summarize, we didn't get them all right, but with several years still to go until 2029, I think an objective score would be pretty good. We are excited to see what our final score will be in 6 years.
One of the most important behind-the-scenes aspects of how tech ecosystems grow and flourish is the flow of talent, Founders and early employees are the venture capitalists of their own careers. They're looking for the next interesting idea as much as investors are, and they're giving their time and energy to the companies they build. Watch the talent, and they'll often lead you to the next great company. This pattern has been playing out for time immemorial. 8 of the key employees of Shockley Semiconductor left to form Fairchild Semiconductor in 1957, helping to launch a family tree of companies that laid the foundation for the silicon in Silicon Valley. In an interesting coincidence, that bridges the East Coast and West Coast tech family trees. The Fairchild and Fairchild Semiconductor was Sherman Fairchild, the son of the chairman of IBM's predecessor company, CTR. He provided the capital for those 8 to leave Shockley, and the rest was history. This timeless pattern is repeating now in Southeast Asia. Zalora is a case in point. Founded in 2012 as a part of Rocket Internet's expansion into Southeast Asia, Zalora now counts over 4,900 alums across the region. It may not be a household name in the West, but Zalora's influence is being felt through its 193 alums who are now founders or CEOs of companies in Southeast Asia, including the founder of Shopee, Chris Fung, the CEO of Love Bonito, Dion Sung, the co-founders of Shopback, Henry Chan and Joel Leong, and the CEO of Vietnam's B Group, Yen Vu. And Zalora isn't the only such academy company, or even the largest by number, though its alumni have been distinctly successful. To discuss this important trend, I spoke with Picha Haroon, a co-founder of Asia Partners, who leads the firm's Jakarta office. Similar to Nick and Oliver, Picha is an investor operator. He worked at an emerging markets venture fund, Unitas Impact, and then, after a stint at Bain & Company, he led a team of 120 people at Bukalapak, one of Indonesia's largest internet companies. Bukalapak went public in 2022 on the Indonesian Stock Exchange, which at the time was Indonesia's largest ever IPO. Pitra, a lot of focus goes into the family trees of just the founders of companies, but you found a way to look deeper into the entire employee base of a company to figure out its genealogy, so to speak. Sometimes this means looking more broadly than just other internet companies.
Thanks, Nancy. That's exactly right. Although Sea, Grab, Gojek, Bukalapak, and others get a fair amount of attention, the ecosystem for talent is much broader. Keep in mind that back in 2009-2012, when our region's first generation of internet companies were getting founded, there were very few other internet companies to hire from. Founders either hired directly out of universities or they cast a wider net to find great talents from other parts of the tech industry, professional services, and even consumer goods companies. And of course, they poach from each other quite a bit as well. A bit like a fossil record, we can see the legacy of all of that in the employee makeup of each company. What we have done is to take a look at each of these 38 companies across 11 categories, which include representative groups of global internet companies like Google and Facebook, traditional tech companies like IBM and the telcos, professional services, FMCG, and 2 generations of Southeast Asia's internet companies. The first generation includes 2 groups, the Indonesia's focused strategy 1 players like Gojek and Bukalapak, and the regionally focused strategy 2 players like Sea and Grab. Just imagine for a moment if you could create a grid for these 38 companies from and to. For each company, how many of their current people came from the other 37 companies? And for each company, how many of their alumni went to the other 37 companies? That is exactly what we did. The results were fascinating. What that lets you do is track the movements of talent across the ecosystem. It is worth pointing out one methodological point. So let's say someone worked at Microsoft and now works at Sea in Southeast Asia. We can say with precision, at least according to LinkedIn, that they work in Sea in Southeast Asia, but we aren't able to say whether they worked at Microsoft in Southeast Asia or in some other Microsoft region. So when we talk about net changes across the ecosystem, there's a little bit of error introduced by talent infos from abroad, but still, we believe the big picture is still fairly accurate.
So share with me the big picture then. What did you learn from all these data points?
Let me start with this visual. It's the highest level synthesis of all the data in one simple page. At first glance, this might look like just a bunch of circles and arrows. but there's actually a lot behind the surface here. We use network analysis software to create this based on the actual talent flows of our tech ecosystem. There are 11 circles on this page, corresponding to the 11 categories of talent on the exhibit a few moments ago. For example, there's a circle for first-generation internet companies pursuing Strategy 1 in Indonesia, and another circle for the first generation of internet companies pursuing Strategy 2 more regionally, and yet another circle for the second generation of internet companies that are increasingly magnets for talent. The proximity of one circle to another denotes how similar one category of company is to another in terms of exchanging talent. The size and the direction of the arrows show the magnitude of the flows of talent. So now let's unpack this. What you see looking at the arrows is that some of these categories tend to be net sources of talent, others are net magnets for talent, and others are in the middle, exchanging talent in both directions. Of course, each category exchanges at least some amount of talent with almost every other category, but we're most focused on the flows that are largest and the net flows that subtract departures from arrivals or vice versa. And it's important to note that today's talent magnet might be tomorrow's talent feeder. This is a very dynamic region and things definitely change over time.
Who are the talent sources currently, the feeders?
It tends to be the IT services firms, the telcos, and the big four accounting firms. And of course, recent college graduates, though those don't appear here as we're looking at company-to-company movements. These three categories definitely resonate with our anecdotal observations. They hire a lot of young people and are great places to start a career. And as every CEO knows, there's more to building a company than just coding. You need hard and soft infrastructure like data centers and accounting teams, project managers and compliance experts, and these organizations are great at teaching those skills.
Who is in the middle then?
There are 5 categories. The first generation internet companies like Sea and Gojek, both Strategy 2 and Strategy 1, the FMCG players like Unilever, the management consulting firms, and the semiconductor industry.
I can see why the consulting firms are sources of talent, but why would you have them in the middle, meaning somewhere between sources and magnets for talent?
That was a very interesting finding for us. While it's true that the 3 big consulting firms, Bain, BCG, and McKinsey, have lost hundreds of people on a net basis to the first generation internet companies, they in turn are hiring hundreds from the big 4 accounting firms and the IT services firms like IBM and Accenture. It's possible the two are related. They need to replace the outflow to internet companies with new recruits.
And semiconductors?
Yes, that was interesting too. A lot of people rotate out of semiconductors into global tech companies like Google, Microsoft, Amazon, Facebook, and Apple. And C has hired almost 70 people out of Micron Technology alone. We'll come back to that in a moment.
And then the final stage of the network graph. Where are the magnets?
That's these 3 categories. Keep in mind that it's not that they themselves don't lose people to the other categories. It's just that they tend to be, in general, net recipients of talent. ByteDance, which owns TikTok, is a great example. It's one of the largest current talent magnets in our entire ecosystem, and this is just their Southeast Asia operations we're talking about.
It's pretty exciting to see the second generation of companies also becoming magnets.
100%. Many of the second generation companies like Shopback were founded by first generation internet company employees. So it's very natural that they become magnets for other first generation talents.
Again, as you say, every employee is the venture capitalist of their own careers.
Exactly. They're looking for what's next and who can put to use what they learned on the job at their previous company.
You said this was the high-level view, so I'm intrigued to take the next card. Can we unpack just one level deeper?
Sure. This is what the network analysis looks like for all 38 companies in our sample. We've replaced the 11 circles for broader categories with the underlying companies itself. It's a little bit more complex, but what you're basically seeing is a higher resolution version of the earlier network map. Think of it as 1080p versus 480p. So what you see here is a much more precise picture. There are some really interesting takeaways which build on the big picture from a few moments ago. To take a step back, it's been over a decade since the first generation of internet companies in Southeast Asia were founded in a remarkably productive 4-year period from 2009 to 2012, which saw the founding of Sea, Grab, Lazada, Zalora, Gojek, Tokopedia, Bukalapak, and Traveloka. Now we call these the Big Eight, and they fall into two natural groups. The four that are more regional in business operations and headcount, which are Sea, Grab, Lazada, Zalora, and the four that are more Indonesia-centric, which are Gojek, Tokopedia, Bukalapak, and Traveloka. That's Strategy 2 and Strategy 1, respectively. As I mentioned earlier, the Big Eight didn't have the benefit of an established community of internet companies from which to hire experienced talent. So much of their hiring was right out of college with plenty of on-the-job training. What lateral hires they could attract often came from outside of the internet industry. So for example, C has over 1,000 current employees who used to work at the Big Four accounting firms, and almost 500 from global FMCG firms like Unilever and P&G. When talent did come from the tech industry, it often came from a much earlier generation of tech. For example, over 400 of C's employees come from IBM or Accenture, almost 350 from Singtel or Telkom Indonesia, and over 100 from the semiconductor industry. Management consulting firms were also popular sources of talent. C has almost 220 alumni of the big three management consulting firms, and Grab has over 100. BCG has been particularly rated for talent, with departures for other players in the Southeast Asia innovation ecosystem equivalent to 46% of its current headcount. I'm living proof of this. I was with Bain before I went over to be an operating executive at Bukalapak. Naturally, with a limited talent base and rapid growth, the Big Eight have liberally poached talent from each other along the way. C currently has almost 3,000 people from other Big Eight firms, Grab almost 1,000, Tokopedia almost 800, Lazada almost 600, and Gojek more than 500. Although talent poaching has gone in multiple directions, we can see clear evidence of a net flow of talent from one company to another. Like you said, employees are the best on-the-ground venture capitalists of their own time and skill, and they are essentially voting with their feet. Among the Big Eight first-generation internet companies, C was by far the biggest net gainer of talent. They had 399 net transfers from Lazada into C, 385 net transfers from Gojek into C, 231 from Grab into C, and 152 from Traveloka into C. Grab was also a magnet for talent, with 64 net transfers from Lazada to Grab and 56 net transfers from Traveloka to Grab. It's fascinating to see that a new generation of internet companies is now taking talent from C. Remarkably, ByteDance, which owns TikTok, has taken a net 831 talents from C, by far the single greatest talent flow in the entire regional innovation ecosystem. In total, an equally remarkable 1,644 net talents have gone from the Big Eight to ByteDance. The ByteDance alumni, over time, will be very interesting to watch. The next generation of internet companies are also drawing talent from the Big Eight. So for example, there have been 72 net transfers from the Big Eight into Shopback and 61 net transfers from the Big Eight into Carsym. The local offices of major US technology companies such as Google, Microsoft, Amazon, Facebook, Oracle, and Apple do have meaningful talent flows to and from the Big Eight. But in general, they are also far more likely to hire from each other or from older generational global tech such as Intel or IBM, than to draw upon the local, on-the-ground expertise of the Big Eight first-generational local internet companies. We believe this is a mistake, or conversely, a source of comparative advantage for the Big Eight. That said, the Big Eight are net sources of talent going to the internet companies Google and Facebook and Amazon, but are net recipients of talent from the software companies Microsoft and Oracle. This makes us excited to follow the new generation of software startups founded by Big Eight alumni in the future. But that's a whole other topic of conversation. The global FMCG players have been active recruiters of Big Eight talent. There are over 300 alumni of the Big Eight at Unilever in Southeast Asia, almost 250 at L'Oreal, over 130 at P&G, and over 100 at Nestle. The majority of this is due to e-commerce hiring from brand.com and channel initiatives at these FMCG majors. But not all. So for example, these four companies have hired almost 100 people from Grab and Gojek, which began as ride-sharing companies, but on a net basis, they are still net sources of talent for the Big Eight, having lost a net 448 people. The interesting exceptions are the Lazada to L'Oreal corridor, which has seen a net transfer of 38 people to L'Oreal, and the C to P&G corridor, which has seen a net transfer of 18 people to P&G. Overall, the impact of Tencent and Alibaba is quite muted in our region. Instead of being magnets for talent, as one might expect based on their overall market caps, they have often been net sources of talent for the Big Eight. So Tencent, for example, has transferred a net 61 people to the Big Eight, largely to C, and Alibaba has transferred a net 144, largely to C and Lazada. Some of this might be artifact of our data collection, as we look at the global employees of each source company, but only local Southeast Asian hiring by target companies. As an aside, it's interesting to see how both the evolution of their business models and the massive poaching from the Big Eight has caused the major consulting firms to evolve their hiring. Bain, BCG, and McKinsey have collectively lost a net 279 people to the Big Eight first-generation internet companies. A small number compared to the net 831 who have gone from C to ByteDance, but large compared to their sizes in Southeast Asia. Perhaps in part to replenish their talent, and in part because their work is increasingly operational and implementation-oriented, the three consulting majors have hired a net 186 people from IBM and Accenture, a net 109 alumni from Unilever, P&G, Nestle, L'Oreal, and a net 317 from the Big Four accounting firms. They, of course, poach from each other as well, with modest net flows from McKinsey and BCG to Bain, and an even smaller net flow from BCG to McKinsey. Singtel and Telkom Indonesia have lost a net 626 people to the Big Eight. The key exception is a tribe of 70 Bukalapak alums who have followed Bukalapak's co-founder to Telkom Indonesia for a net transfer of 20 people to Telkom from Bukalapak. As noted earlier, the Zalora alumni base is hugely influential in Southeast Asia. Part of why is the sheer size of it. There are 4,900 Zalora alums compared to just under 2,500 still with the company today, a 2-to-1 ratio. In contrast, C's ratio is 0.6 times and Grab's is 0.5 times. Zalora alums co-founded Shopee, C's homegrown e-commerce division, Shopback, and Gojek, for example. There will definitely be more in the future. Our homogeneity index looks at the extent to which two companies are similar, looking at the gross bidirectional flows between each relative to their combined current employee size. On that basis, Deloitte and EY are the two most similar companies in our innovation ecosystem, followed by Deloitte and PwC. Looking at the Big Eight, the most similar companies are Lazada and C, followed by Traveloka and Tokopedia, followed by Grab and C. On the other end of the spectrum, the two members of the Big Eight with the least talent overlap are Gojek and Zalora. And this despite the fact that 28% of Zalora's current employees are in Indonesia, and the also relevant fact that one of Gojek's founders was the former MD of Zalora Indonesia.
Fascinating. Having this data is almost like a radar system for the entire ecosystem.
Exactly. And there's actually one final level of detail we can dig into, which lets us look at each individual company with precision, where their people came from and where they go. We call it the nutrition facts page for each company, just like on the side of a food package.
Well, at the risk of being corny, you are what you eat.
I think that was a true statement and a food pun, all in one. But it's true, companies are what they eat in the sense that they also embrace the culture and best practices and industry expertise of the people that they hire. Let me start with an example everyone will know. Google. It's one of the most ubiquitous internet companies in the world, and they have about 14,000 people in Southeast Asia, according to LinkedIn. The left side of this chart is just like a nutrition facts label. It shows you the ingredients of Google in Southeast Asia. Just under 5% of their people came from other global tech majors, meaning Microsoft, Amazon, Facebook, Oracle, and Apple. In contrast, only 2.4% of their people came from these four homegrown first-gen strategy to internet companies, and less than 0.5% from these four homegrown first-gen strategy 1 companies. Now, on the right side of the page, you see their alumni. LinkedIn says they have 6,100 alumni in the region, and the biggest cluster of them are in the same category, global tech majors. The largest group by number go to Facebook, but almost as many go to ByteDance. Finally, at the bottom, you can see how they're executing their talent strategy from a regional standpoint. Again, keep in mind this is based on what LinkedIn says, and the actual numbers are probably a little bit different, so take this data as directional only. They have about 26% of their people in Singapore, which is about 2 times ratio a Sea or Grab would have in Singapore. Interestingly, they have a lot of people in Indonesia, which makes sense given that market size. Now let's flip to our region's largest homegrown internet company, Sea. This is again all based on LinkedIn's data. Probably the most interesting thing about the left side of the chart is how few clusters there are. Yes, there's been some hiring from Grab and Lazada, but the inescapable conclusion is that Sea probably had to hire a lot of very young people from college or other early career employees and train them up on the job. The remarkable thing is what's on the right-hand side of the page. 966 people have gone from Sea to ByteDance. That is one of the most interesting single findings of this entire analysis, and it speaks volumes to TikTok's ambitions in e-commerce in our region. Which brings us to ByteDance, which in our region is largely synonymous with its subsidiary TikTok. Look at how different the left-hand side is from Sea. Sea was started in 2009 when there were only the early inklings of an internet talent base. ByteDance is a much more recent arrival to Southeast Asia. And what a difference that makes. Almost 10% of their Southeast Asia employees came from Sea, just under 3% from Grab and Lazada, and interestingly, 5% from Accenture. They're looking for great people from all the categories. In fact, there isn't a single one of the 11 categories of companies, from global tech majors to semiconductors, they haven't tapped into for talent. Finally, we'd like to highlight the superb second-generation homegrown internet company, Shopback. It's our most recent investment, but leaving our own fondness for the company aside, it's a great case study of how the second generation builds on the first. Again, compare the left-hand side, the nutrition facts, to Sea. Almost 20% of Shopback came from the first-generation Strategy 2 companies. That makes sense, since although Shopback is a second-generation company, it's also a Strategy 2 company with operations in almost a dozen countries across Asia. And take a look at the lower right for a moment. This shows the rotation of people from one category to another when they work at Shopback. It basically says, relative to the entry mix of the company by category, what is the exit mix? Let me give you a practical example. Now, although 20% of Shopback's talents came from this first-generation Strategy 2 companies, only 8% of Shopback alumni go back to first-generation Strategy 2 companies, for a delta of about negative 12%. Meaning, there really is a concept of first-generation and second-generation companies. You start at first-generation company and then generally progress, at least in this case, to a second-generation company. Perhaps over time, Shopback will help seed the third generation of companies.
So do you have nutrition facts for the other companies?
Yep, we have them for each of the 38. They're pretty interesting to flip through. They're all in the 4th edition of our report on our website.
Fascinating. I don't think I've ever seen this kind of analysis before.
Well, it's not hard to do. You just need a LinkedIn recruiter account and, well, plenty of spare time. It takes a lot of searching, but the results we think are worth it.
There's no question that 2022 was a challenging year from a macro standpoint. So where are we in the macro cycle?
Nancy, it's something that's been very much on our mind these past few years. In our study 2 years ago, back in February 2021, we posed the question, are today's public equity markets overvalued? One of our favorite metrics is the Warren Buffett ratio, which looks at the ratio of total market cap in a country or a region divided by its GDP. You can almost think of it as a PE multiple for a country. Mr. Buffett famously said that if you looked at that ratio for the US in 1999 and 2000, you would have seen the dot-com bubble for what it was. But the challenge with calculating that ratio today, just by looking at US market cap and dividing it by US GDP, is that, well, first of all, US companies are very global today. My colleague Frisco will share more about that later when she talks about Model 1 countries whose total addressable market is the entire world. Dividing the market cap of American companies with global P&Ls by just America's GDP is sort of a numerator and denominator mismatch. And second, we want to have a global perspective, looking at the market cap of the entire world divided by the GDP of the entire world. That's what we started doing back in early 2021. The left-hand side of this graph shows the growth of global market cap in trillions of US dollars. The middle shows global nominal GDP, also in trillions of US dollars. And the chart at the right shows the ratio of the two. By January 2021, the ratio was already higher than the peak just before the 2008 global financial crisis. It felt high. Almost a year later, in November 2021, we had published our third report. And this time, we had a very specific view on whether the global public equity markets were overvalued. There's a wonderful book by the legendary investor Sam Zell called Am I Being Too Subtle? That's how we felt about our message in November 2021. We put it there in a 100-point Garamond. We said yes. If you look at why we said yes, about 14 months ago in November 2021, it was based on the exact same analysis. The ratio had gone even higher to 1.26x, 126%. That was so much higher than the 107% peak in late 2007 that we felt that markets were definitely reaching their peak. We weren't sure when the final peak would be, but we felt it was only a matter of time. In retrospect, as they say, it's better to be lucky than smart. We were lucky. November 2021 was precisely the peak in the markets, and they've fallen by more than $20 trillion globally since then, which you can see on the left-hand side. More important from our perspective, the ratio has fallen too, from 1.26x to 0.96x. The question that's now on our minds is whether it settles there at 0.96x or whether it falls more. No one can say, of course, with certainty, but consider these data points, which are a histogram of what that ratio has been since 2003. 1.26x was the peak, 0.42x was the trough at the depths of the global financial crisis, and 0.83x down the middle is the 19-year median. We're still north of that, all of which makes us worried that there's probably another 10 to 15% at least in correction still ahead of us, and perhaps more. When markets correct, they don't just glide down to the median like Captain Sully landing safely on the Hudson. Take a look at this lens. The left-hand side is what we saw before, the growth of total global market cap since 2003. The black line is the trend line. It's a roughly 7.1% annual growth rate. This is the growth rate of human market cap over roughly 20 years. The right-hand side tries to iron out the chart at the left, anchoring around the trend line and looking at the oscillations up and down, high and low. What we can't help but observe is that it's a bit like high school physics when we learned about pendulums. Pull the pendulum a foot this way, it's going to swing back a foot this way. Markets were 50% above trend in 2007, then fell to just under 50% below trend in 2009. It's a little unscientific, but they were 27% above trend in November 2021, and they've only just fallen to 1% below trend now. Markets often overreact, so it's entirely possible there could be a correction of even more than 10 to 15%.
You know, the late Paul Samuelson joked that the stock market has predicted 9 of the last 5 recessions. Does this mean that there's going to be a recession in 2023, or is the stock market overreacting to that? Could this just be a valuation correction and not the harbinger of an economic recession?
Well, to allude to another economics joke, Ruchir Sharma just wrote an op-ed piece that said, economists see recession coming, so maybe it's not. I think economists are getting a bit of a bad rap there. But plenty of others are trying to convey that it might be a soft landing or not a recession at all. Some of this is entirely sensible messaging by civic leaders, since there can be a recursive loop of worry becoming a self-fulfilling prophecy. But as always, we love to try to learn from the past. Take a look at this chart. The dark blue line is the 10-year US Treasury, and the light blue line is the 2-year US Treasury. You can see that the dark blue line is typically, but not always, above, higher than the light blue line. The difference between them is called the Treasury spread. And when you plot that, again, you see it's mostly greater than 0, but every once in a while turns negative, what's called an inverted yield curve. That inversion, that moment that it dips below 0, is often a terrific predictor of recessions. In fact, when you see recessions over the past many years, they've typically come somewhere between, call it a half a year to 2 years after that first moment when that red line dips below zero. The red line dipped below zero several months ago, which suggests, if the past is any judge, a recession is imminent sometime in 2023. But it's funny, like they used to say in the 1990s, you could see the evidence of the productivity of technology everywhere but in the productivity statistics. You can see the evidence of an upcoming recession everywhere but in the forecast for earnings per share for the S&P 500. Again, we're using a very US set of numbers over here because the data is available, but this is generally applicable to the entire world because these companies are, in many cases, multinationals. What you're looking at over here is quarter by quarter the actual delivered earnings per share for the roughly 500 largest American companies. As you can see, when there's a recession, it's brutal. Those earnings dip and cascade downwards in a massively negative way. This next chart shows you what people think is going to happen 3 quarters from now. You can see that there's already a forecast for 3 quarters from now, and you can see forecasts from years past. There's 2 things worth pointing out. 3 quarters in advance, almost nobody saw the 2008 recession coming. Almost nobody saw, for different reasons, the COVID recession coming. And right now, despite the inverted yield curve and despite raising rates, no one is really calling for a dramatic decline in earnings per share. We find this very, very puzzling. It's true when you even take a larger or a longer term view. This is the forecast 7 quarters out, built up for the S&P 500. It's only until well into the recession in the past that people have actually begun to predict what those earnings would be, and then very rarely do they tend to be accurate. And right now again as well, no one is predicting the kind of dramatic drop in earnings per share that it would be typically associated with a recession, which is what we think will likely happen over the next 12 months. Here's another way of looking at it. If we had the data quarter by quarter of what people originally thought was going to be the earnings in the past and getting closer and closer to the actual date, but looking at it in advance, what you see is a consistent pattern, almost like grass blowing in the wind, of downward lines. The way to think about this is people thought next year's earnings would be here, and as it got closer and closer to reality, they kept having to tone down their expectations until it actually turned into the actual number. This is not a great fact pattern. It actually says that there's systematic optimism bias among many forecasters that look at the largest group of companies in the world. The other way to look at it would be to say, all right, at every moment in time, what did people think was going to happen next? For example, at Q3 2017, what did people think the next 7 quarters of earnings would be? This looks like grass blowing in the other direction. It's consistently over-optimistic, and like that broken clock that's right twice a day, it's only occasionally directionally accurate. Most of the time we over-index and overestimate, and we think that's exactly what's happening now as people start to model earnings for 2023 and 24. Those numbers will come down a lot more than this is forecasting if a recession actually takes place. Now you might be asking, you've been thinking a lot about the US, talking a lot about the US, how is this possibly relevant to Southeast Asia? Well, on this chart, what you see is in black, the United States' GDP growth rate year by year going back quite a bit. And you also see Southeast Asia's 5 largest economies, the ASEAN 5. You see all emerging markets and the entire world. And in general, over the past 20-odd years, these have been correlated. Not perfectly. We're proud of the fact that ASEAN does march a bit to its own drum. But in general, if the US has a cold, we might have 3 colds, because emerging markets often move in lockstep to what's happening on a global basis. So what's happening in America and the likelihood of a recession there does have great importance for us here in Southeast Asia.
How does a startup founder's job change in a recession? How should their planning adapt?
The job of a CEO has gotten much, much harder over these past few months as a recession looks increasingly imminent, and their planning has to adapt to changing times. We love trying to contextualize what a recession looks like, particularly from the standpoints of the capital markets, because that has a great bearing on a company's ability to raise capital and eventually seek capital market exits in the IPO and aftermath markets. What you're looking at the top is the US S&P 500 over almost 100 years, and at the bottom, over the same time period, although the index only began in the 70s, the US NASDAQ. But we're plotting these 2 important indices in a very different way. Instead of showing it the usual up and to the right with ups and downs, we say at every moment in time when there was a kind of high water mark, when the index reached a new high, and then subsequently fell from that high, how long did it take to recover to the most recent high? The results are dramatic. Look at the Great Depression. You can see the enormously long time it took for markets to recover from the massive overvaluation of 1929. It took a while in the 1970s to recover from the go-go years of the 1960s. It took a while at the dot-com bubble, and it took a while after the global financial crisis. And where we are right now, as painful as 2022 was, is actually relatively sort of midstream in a correction relative to the magnitude of corrections in years past. That is not just true for the overall corporate environment, it's true for tech. Now, the NASDAQ doesn't go back beyond 1970 or 71, but what you can see are many punctuated episodes of NASDAQ declines, the most awful of which, of course, was the dot-com crisis. We haven't even begun to get close to the magnitude of declines that took place in that crisis, which again gives us some food for thought to think that perhaps this correction is not yet completed in terms of where it's likely going to go. What does that mean in terms of an entrepreneur's decision making? We often think about this in terms of very practical rules of thumb that an entrepreneur has to go by, and we take some inspiration from the 3 laws of physics from Isaac Newton, although apparently the Apple story is apocryphal. Let's start with a basic mathematical fact, so important a fact that actually we're surprised it hasn't been named. We're just going to call it Nguyen's Law, in honor of our co-founder Ken Nguyen, who is often a true contrarian in our investment committee meetings. If A times B equals C and A falls by 50%, B doesn't have to rise by 50% to get back to where the multiplication used to be. B has to rise by 100%. If something falls by 20%, it'll have to rise by 25% to get back to where it was. That's an important mathematical fact. If your earnings fall by 25%, you'll have to grow them by more than 25% to get back to where you once were. Which leads us to the first law of recession valuations. In a recession, your revenue or gross profit or earnings multiple will usually fall a lot more in percentage terms than the associated metric will rise. Your PE multiple can fall a lot more than your earnings can rise. And that's assuming you have earnings. There's an important corollary. GMV multiples and every other kind of multiple fall as well. It's not just the canonical gap metrics. There's a clear implication. It is almost impossible, although a handful of companies do this, to have a rising share price in a recession. It almost doesn't matter how quickly your P&L is growing. Your multiple is falling faster. Back to Nguyen's Law. The second law of recession valuations is that it is a lot easier to raise money if you don't need the money. And there's a clear corollary. Revenue multiples probably don't matter as much anymore. People are going to be looking at your cash flow, and not just 4 or 5 years from now's cash flow, but your relatively imminent cash flow. And it has a clear implication. It is so much easier and frankly better to spend $1 less at a time like this than to try to raise $1 more. Which leads us to our third law of recession valuations. It is actually a bit better to own a bit less of a business that survives than a business that goes bankrupt. In fact, it's more than a bit better. It has a clear corollary. This is the time to be practical in valuation. We don't just say this because we're investors. We say this to all entrepreneurs, including the ones we don't invest in. This is the time to be practical and very pragmatic about valuations and capital raising. And there is also an implication we'll touch on in a minute. When capital supply shrinks, a game of musical chairs, just like a children's birthday party, ensues. And in every game of musical chairs, the first person to sit down will win. Raise early. Don't wait for the money from supply or your own balance sheet to run out. You saw this happen at many times in the past. In the dot-com recession, for example, Apple's revenue multiple fell by almost 90%. Over that period of time, its revenues happened to fall as well, but it certainly didn't help that that multiple fell. Amazon's an interesting one. Amazon's revenue multiple fell massively. Over that period of time, its revenues doubled. But when your revenue multiple goes from 12 to 16x down to 2x, it doesn't matter if your revenues doubled. You're still going to have a reduction in your share price. Similar results obtained as well for the global financial crisis. Back to the second law. It's a lot easier to raise money if you don't need the money. Take a look at this. There's a fantastic academic at the University of Florida called Jay Ritter, who's made it his life work to analyze and to quantify US IPOs over a very long period of time. What you're looking at here is just tech IPOs, companies that went public in the US like C did back in 2017, and it shows you what percent of each year's cohort of IPOs were profitable tech companies in green or unprofitable tech companies in red. The results are striking, and much of what you see here is the direct practical result of 40 years of shrinking interest rates. When interest rates fall, investors are more willing to give you credit for outcomes far in the future. In fact, they give you a lot more value for what's called a terminal value than profits right away today. This oscillates up and down, and what you saw, for example, in the dot-com bubble was an enormous expansion of the red, which quickly pulled back, in fact, all the way up to the 2007, 8, 9 global financial crisis, and then it fell back down again as interest rates fell during a uniquely low period of rates. You can already see the green, the green section rising. This is hugely important. It's easier to raise $1 in a recession if you don't need the money. Why does capital dry up in a falling market like this? After all, we keep reading newspaper articles about the dry powder that's surrounding us all around the world. Plenty of venture capital firms and private equity firms raised bumper-sized funds in 2020 and 21 and even 2022. Well, the reality has to do with positive cycles and vicious cycles. In a rising market, investors have an incentive to invest because the good companies may be even more expensive 12 months later. Their revenues might be higher, their margins might be better, the multiples of that might be better, and therefore valuation is probably going to rise. You're probably better off investing now rather than later. And in rising markets as well, particularly for early stage investors that need subsequent rounds to bring their companies to full fruition, it's a lot more plausible that you'll find someone to put that capital in the next round, rather than needing to reserve your own capital to see your company all the way to cash flow positive. That reverses in a falling market. It's in fact exactly in reverse. It becomes a negative feedback cycle. In a recession, revenues might be lower a year from now. Margins might be lower a year from now. Multiples might be lower a year from now. And therefore, there's a lot of good reasons why valuations might fall. So investors sit on the sidelines, waiting to see what might happen, hoping for better prices and better terms in the future. And by the way, that second point is very important. In a falling market, there's even less of a guarantee that subsequent investors will come in and provide growth capital for your company to keep them what accountants would call a going concern. And therefore, you actually need to set up more of a reserve for your existing investments because you need to protect them at all cost. We saw this working in a very tragic way in the dot-com implosion of 1999, 2000, 2001, and 2002. There's a terrific data set that looked at, again, from a US perspective, what was the pitter-patter of bankruptcies. The graph at the bottom corresponds to the shaded area in the chart at the top, and the chart at the top is exactly what we talked about before. The drawdown of the NASDAQ relative to its high water point. Again, it's worth pointing out that it took many, many years, well into the 2010s, for the NASDAQ to recover from its peak valuation in 1999, 2000, and that doesn't even adjust for inflation. But I want to bring your attention to the bottom part of this page. It looks almost like a mountain climbing and falling. That's what recessions look like in terms of companies going out of business. And when you looked at the substructure of who went bankrupt earlier and who went bankrupt later, at least the last time around we had a tech bubble of the kind of magnitude we may be facing around the world right now, it tended to be the B2C companies that went bankrupt first. And the B2B companies, those that had convinced themselves they had some degree of recurring revenue, that went bankrupt later. And why was that? Well, part of it was long-term contracts. Part of it was a degree of predictability in their business that let investors support them early on in the recession. But ultimately, what many of those B2B companies found was that other B2B companies, startups, and other B2C company startups were also an important part of the revenue base. And when the left chart of this bell curve went bankrupt, the right part of the bell curve went bankrupt in close succession. All that said, it is possible to create shareholder value in a recession. There were several thousand public companies at the beginning of 2008, and about 9% of them were able to create shareholder value over that period of time. If you look at the countries, look at the business models, it's a wide variety, all very unique and relevant to the times back then. But we want to emphasize, even in a recession, it is possible to create value, but it requires, according to Nguyen's law, whatever your decrease in multiple is, it must be more than offset by the increase in your revenues or your gross profits or your cash flows.
Usually, when you are worried about a recession, the Fed starts cutting rates. The yield curve has already inverted. But this is a unique situation. We're also experiencing runaway inflation, the most in almost 30 years, if not longer. So what are the Fed's degrees of freedom here?
The Federal Reserve is trying mightily after a little bit of a period of perhaps, let's just say, artificially low rates to try to conquer inflation. And we take a great cue here from a friend of our firm's, John Taylor. John Taylor was a member of the faculty at Stanford, is a member of the faculty at Stanford, was active in government, and he promulgated in the early 1990s something that's now called the Taylor Rule. In fact, it's such a simple, elegant idea, it fits on a single line of text on the right-hand side of this page. And what the Taylor Rule essentially says is, if GDP growth is a little soft relative to what it ought to be, well, you should lower rates a little bit. But if inflation is higher than it ought to be, you should raise rates a lot. Which means in a time when GDP growth is soft, but inflation is high, the net effect is still to raise rates. If you look at the last roughly 50, 60 years, even though the Taylor Rule was first laid out in the early 90s, the Taylor Rule does a pretty good job of actually measuring what the Fed actually did, except over roughly the last 10 years when rates were much, much lower than what the Taylor Rule would suggest. We want to actually visualize this for you. What you're about to see is a bit of a movie. It's effectively a sequence between what the Taylor Rule predicted the Fed rate should be on the x-axis and what the actual Fed rate was on the y-axis. You can see periods of time where we're below the diagonal, like the 1970s. The Fed's rates were too low. And that gets counteracted by the Paul Volcker years in the 1980s when the Fed had to raise rates to fix the ills and the sins of the 1970s. It was on the other side of the diagonal. But look at where we were over the past 2 years. And it's easy to criticize the Fed. That's not our intention here. But look at the data. If you think about a couple of years back, the Taylor Rule actually projected we should have negative interest rates, which the Fed tried to do through a combination of a zero Fed funds rate and quantitative easing. But over a short period of time, what the Taylor Rule predicted the rate ought to be started climbing. In fact, it started to go much, much higher, approaching 10%. Yet, the Fed kept rates at zero. We were starting to peel very far away from the diagonal. In fact, it has only really been in recent months that the Fed has begun to raise rates, just as the Taylor Rule starts to suggest that actually, had we followed the Taylor Rule, or at least had we found ourselves where we are today, we would actually want to start cutting them. Now, what are we trying to say here? In effect, the Taylor Rule said that we should have raised rates much, much faster and much, much sooner than what actually took place. And that, in addition to all the things we know about, like war in Europe and supply chain and COVID, is a major driver of the inflation we find ourselves in right now. And here's the dilemma. It isn't just enough to raise the Fed funds rate to be about equal to inflation. Look at the circles on this chart. Every single time that inflation has been an issue, the Fed funds rate in blue has had to puncture the red line and go way above it to try to tame inflation and bring it back down to where it needs to be. That's part of how inflation has been so low in the developed economies for such a long time, and even by extension around the world over the past 20 years. There's been discipline around puncturing the red line. But look at where we are right now. The blue line is still well below the red line. We believe that has only one implication. The blue line has to barrel through the red line sooner or later. Now, what does that look like, in fact? Well, let's show you another video. This basically shows you what the inflation rate is, measured as the PCE inflation, versus the actual Fed funds rate. Anytime you're in red territory, it's a dangerous place to be. Inflation's actually higher than the Fed funds rate. If you're in white territory, well, it's the other way around. This shows you the progress of the last several years. You can see the very dangerous 1970s when the Fed probably acted too slowly, and then the massive but necessary correction under Paul Volcker. And now you can see the plot continuing into the 2000s and eventually moving to the present day. Take a look at where we are. And here we are. It's remarkably similar to what took place in the 1970s. The parallels are ominous and very, very real. The further you are in the red zone, the more dangerous it is. And it may not be enough to just cross over the diagonal line. Just like Paul Volcker did in the 1980s, it may be important to cross meaningfully into white territory, into the right side of this page, in order to fully tame inflation.
Which raises a very practical question. Until inflation is quenched, and that might take a while, who benefits from high inflation in terms of sectors or business models? Commodities, of course, but who else?
In a time of high inflation, there's no doubt that commodities do very well. Anybody that had exposure to oil or other sorts of commodities had an extraordinarily successful 2022. I was just exchanging notes with the guy that was the most successful mutual fund PM in America in all of 2022. He had a third of his portfolio in an energy royalty company. That did well for him that year. But who else, other than commodities, and from a tech perspective and a consumer internet perspective, who prospers? Well, let's take a walk down memory lane. There have been 11 spikes of elevated US inflation above 5% on a rolling 3-year basis in the last 140 years. And again, you might ask, you guys are Southeast Asia guys, why do you care about this? We care about it because the US is very well quantified. We can find lessons from the past. And by the way, the current affluence of Indonesia is roughly where the US was in the Rutherford B. Hayes administration, plus or minus a decade or so. So we love learning from the past and applying it to the situations we find ourselves in today. 11 situations, 11 circles on this chart. Now, some of these crises go back a pretty long time and the data's not that great. Let's start with the very first of these crises. September 1948, just after World War II ended. What you see here are 4 companies that had pretty extraordinary 3-year IRRs to public shareholders. And there's a common theme: affordable, value-oriented consumer products and services had terrific IRRs. In the 1970 spike, again a terrific theme: affordable consumer products and services. Volume Shoe Corporation, now known as Payless. It's certainly a store that every immigrant family to America knows extremely well. 1975, a common theme: affordable consumer products and services. Jericho's Fast Food, the Echo Group of affordable home kitchenware, American Stores, Mervyn's, great examples. 1981, again, Mary Kay Cosmetics, very affordable. MacFrugal's Bargains Closeouts, Radio Shack, La Quinta Inns, very affordable, consistent quality price point consumer products and services. 1991, the most recent spike until the present day. Blockbuster, you might not think of that as a frugal company, but think about the $5 cost of renting a video compared to the $25 cost of bringing your entire family out to the megaplex. Costco, Home Depot, Walmart, Southwest Airlines, the whole era of everyday low prices was a terrific winner during this period of low inflation, high inflation. And look at the IRR, 81% annualized over 3 years. Phenomenal IRR. And now the present day. We can take a somewhat more global view, lots more countries to look at, and much better quantification. Alphamart, a terrific company in our region in Indonesia, 41% US dollar IRR. Tractor Supply in the States, rural, affordable, everyday low prices. Spartan Nash, no relation, 29% IRR. Europris in Norway, not a low affluence country, a very affluent country, but very affordable variety retail, 21% IRR in dollars. This is a very important theme, and we would like to call it something practical and relevant, which is what we call frugal tech. We are very much frugal tech investors. Shopback in our portfolio is all about cash back for consumers. Red Doors is affordable 1, 2, and 3-star hotels. Snapask is effectively democratizing tuition to make it buyable almost by the drink. Gurangada is all about very bottom of the pyramid retail and improving efficiency to drive affordability. Carsome is the largest used car marketplace in our region, a much more affordable option than buying a brand new car. And SCI, of course, permits consumers to buy cross-border, often availing themselves of great prices from imported goods. This is going to be one of the most important investment themes over the next several years, along with cost-cutting in general for corporations and all the businesses that enable cost efficiencies at the SG&A line item. But mark our words, what should CEOs do in a recession? They should be thinking about what their frugal tech strategy should be.
If interest rates rise to lower inflation, what does that mean for valuation multiples?
Nancy, it's a great question. Again, we talked earlier about how the blue line of the Fed funds rate has to puncture the red line and stay there for a while. Or back to the video, you have to cross over from the red triangle into the blue zone. That is going to have a pretty meaningful implication for exit multiples for companies, which we think should have an implication on how people think about entry multiples for companies. To talk about that for a second, again, if the blue line rises, that's going to have a cascading impact. Let me start with a nice data set that Robert Schiller at Yale has put together. Some of you have seen this before. It's basically about 140 odd years off the S&P 500's trailing 10-year PE. He calls it the CAPE, the cyclically adjusted PE multiple. Now this is very interesting in terms of just applying it to a set of earnings, but just humor us for a second and take what we learned in math class as kids, the reciprocal. This is A. Let's take 1 divided by A. You go from being 30x to being now 3.3%. And by converting the multiple into a yield, that lets us do something very interesting, which it lets us superimpose this exact same yield chart of earnings for equities on the yield chart for the 10-year Treasury. An equity owner in a business is taking a medium to long-term view on its prospects. From a DCF perspective, that's certainly what the 10-year Treasury is as well. And when you put the blue on top of the green, the eye can't help but notice, with the exception of some very interesting things that happened many years ago, there's basically a correlation. They sit on top of each other. In fact, over long periods of time, there's about 100 basis points of difference. The equity yield is about 100 basis points higher than the yield in the 10-year Treasury. So it's not hard to follow the logic. If short-term interest rates have to rise to tame inflation, a la the Volcker years in the 80s, then there will be a consequent upward momentum on the 10-year rate. It may not be pound for pound, percent per percent, but the 2-year horizon is part of the 10-year horizon. If the 10-year rate goes up, well then earnings yields tend to be over long periods of times 100 basis points higher, which means when you unreciprocal it back to a multiple, PE multiples will fall. This is a simple point to say, but hugely important. Over the last 40 years, most equity investors have been what I like to call kick-saved. They've had narrow misses where they often misjudge, and I certainly fall in this category, I've gotten it wrong a lot of times, misjudged the P&L and it was actually lower than they forecasted, but the IRR turned out okay because multiples were better than expected, because 40 years of lower falling interest rates and therefore 40 years of rising PE multiples. The paradigm is likely going to change. I sure hope for a low interest environment sometime, certainly again in my lifetime, and it will happen. But the next few years are going to be crucial and we cannot bank on it, which means as we underwrite investments and we think about exits, we have to keep in mind falling exit valuation multiples. That has a very clear consequence for founders and entrepreneurs of companies. I love this imagery of how people are a lot more frugal with their toothpaste when it's running out of toothpaste. You fold up that tube, and they're a lot less frugal when it's right out of the store. One of the things that's so powerful that my colleague Peter has discovered is that when you think about Southeast Asia private deployment into tech investments pre-IPO, it tends to correlate pretty well with the movement of the NASDAQ with a bit of a lag. We looked at a 100-day lag in this particular exhibit. Let me show it to you in a somewhat different way. This is the total amount of capital across all stages of capital, not just the Series C and D that Oliver talked about, going back to the mid-1990s. The blue periods were times of crisis in Southeast Asia, economic crisis or otherwise. You can see the impact of the Asian financial crisis, the impact of the dot-com implosion, the global financial crisis, and we're only partway through what will be the 2022-23 slowdown in capital raising and capital markets. And by the way, if it's tough for all of Southeast Asia, at least historically, it's been even tougher for Indonesia specifically. There have been years, and some of this might be data availability, when that capital has gone almost to zero. Not in terms of LP commitments to funds, and not in terms of necessarily spending by companies, but capital going into companies by funds, year by year over this period of time, all stages. In fact, you're already starting to see something very interesting happening related to capital productivity. Our friends at Morgan Stanley produce this analysis every few weeks. If you look at just software companies, and again, it is US-centric, but the data is very illuminating for what's happening all around the world. If you are a high growth and profitable software company, well, now you're trading at 8.8 times 2023's revenues. But if you're only moderate growth and unprofitable, that's a dramatically different multiple. There is now intelligent and thoughtful discrimination between the top of this chart and the bottom of this chart in terms of how investors are valuing companies. That's again something that entrepreneurs have to give a lot of thought to.
Which brings us to the million or even billion-dollar question. When will the IPO markets reopen?
Nancy, it's a very important question and one that we're thinking a lot about. We've got a bunch of our companies that hope to go public one day in our own portfolio. It's also a topic that's very close to my heart. One of the great opportunities I had in my career, I'm so grateful for it, was the opportunity to be the president of Seat Limited and lead its IPO back in 2017 on the New York Stock Exchange. And Sea's IPO wasn't just an enjoyable event and an interesting learning event, it's created real shareholder value. Now it's gone up and gone down over the years, but over the last roughly 5.5 years since Sea's been public, it's been one of the 75 best performing large cap stocks on earth on a long-term basis had you bought at the time of the IPO. In fact, relative to other IPOs of large companies today, it's been one of the very best performing IPOs globally across all industries and one of the very best from a tech perspective, again, among somewhat larger companies that are out there in the world today. So we feel very proud of what Sea's done and our affiliation with it, but also more importantly, the learnings that we can draw from that in terms of thinking about where the IPO markets go next. Now it's worth pointing out that although Sea's IPO created a tremendous amount of value from its 2017 launch point to today, many of the IPOs more recently, especially in 2021, have not done as well. There were about 100 or so global tech IPOs in 2021, and the majority of them have broken issue price. They're on the left-hand side of this page in the red columns. A handful have created value, but far more have lost value. And this has created a little bit of a mood of pessimism all around the world. It's made people question, did we do the right thing or the wrong thing in terms of investing in those companies? We're not going to answer that question, but we will say the following. If you look at how IPOs do at the 1 year point after their listing, over a pretty long period of time, you see a 3 or 4 year cycle. We would sort of call this partly linked to the macro cycle, but frankly, there is a 3 or 4 year cycle in terms of IPOs being overvalued or undervalued at the time of their listing. When C went public in the second half of 2017, actually many companies that went public in that cohort, the second half of 2017, the median company was about flat over the first year. In fact, C itself had a pretty bumpy first year. I remember that vividly. However, the IPO class of 2021, they didn't just have a flat performance, they actually declined. And there have been many periods in the past, again, that 3 or 4 year cycle, where the classes actually declined. In contrast, there have been years, and you can see them on the chart, where the median IPO has done very, very well. We would simply point to this data set and say, look at 2021 in context. There's a cycle, and it was definitely a time of very overvalued IPOs, whereas 2017 was somewhere in the middle, and there have been years when IPOs were arguably underpriced and did very, very well in the aftermarket. Which raises an important question. How big does a company need to be ready to be a public company? Now, we focus a lot on gross profits. We think that gross profits really separate the great companies from companies that are, as they say, selling $1 for a nickel. If you look at every IPO from emerging Asia going back a pretty long period of time, this is basically Asia excluding just Japan, and you look at the current gross profits of the company on the vertical axis and the year the company went public, obviously it drifts upwards to the upper left because those companies have been around longer, they've had more time to grow. But in general, once you're at about $25 million of gross profits or greater, you're definitely a contender to be a public company. Now, this is all industries, all exchanges, including some of the smaller local exchanges. If we now just look at the subset of those IPOs that were technology IPOs, specifically internet and software, again, interestingly, roughly $25 million of trailing gross profit. And if we take one final aperture and look at the companies that went public in America on the New York Stock Exchange or the NASDAQ, again, about $25 million-ish, maybe a notch higher than that. This is a very important goalpost. When your company has $25 million plus of gross profits, that's the time to start thinking about going public in the US or locally here in Asia. But there's a second rule of 25, and that one isn't in an entrepreneur's control. It's when will the markets be ready for your company? You might be ready, but the market might not be. We call it the second rule of 25 for the following reason. What you're looking at over here is called the VIX. It's basically an indicator, and it actually moves up and down day by day, of how the markets think the next few months of volatility will be. When the VIX is high, people are worried about future volatility. When the VIX is unnaturally low, people are unnaturally complacent and calm about the markets. And if you take a look at this, it effectively quantifies capital markets fear. This is, as much as anything else over 30 years, a psychological end product. And it looks exactly like this. Now this looks at 1990 to the present day. If you overlay with a somewhat rescaled right-hand side axis, just the last, give or take, 12 or 13 months, you can see that the VIX over the course of 22 has been a lot more elevated in terms of its distribution relative to the normal functioning of the global capital markets and the VIX in particular. This has a very important implication. And here's why. If you look at all the money that was raised in tech IPOs globally over the past 30 or so years, by the level of the VIX on the day the company priced its IPO, you see a very strong drop-off after 25. In fact, when the VIX is 25 or greater, there's a tremendous reduction in the amount of capital raised. Now you might say, well, hold on a second, that's just an artifact of the fact that on the previous page, the VIX isn't often above 25 anyway, so wouldn't you expect it to not raise that much capital above 25? Well, that is true, and we can adjust for that. So if you now look at how much capital is raised per trading day, whether or not an IPO happened or not, but per trading day to sort of index for that, what you see is something very interesting. Now on the surface, you might say, well, this doesn't seem to show much of a pattern. Yes, there's a small drop off at 25, but what you also have to do is recognize that there's three major outliers here, largely linked to large telecommunications IPOs, many of them quite far in the past. When you really take those out and think more about internet and consumer and software companies going public, it is much, much harder to do that when the VIX is greater than 25. Which raises a great question. How long can the VIX stay above 25? What is that likely going to look like? Well, the VIX as of the day of this filming is actually briefly below 25, but over the course of 22, it's been quite elevated. And if you look at previous periods of time on a calendar day basis, what this chart at the top, which sort of looks like those stalagmites in a cave, is showing you is the number of cumulative days where the VIX was greater than 25 since 1990. And you can see there was a massive period of time around the global financial crisis when the VIX was indeed much greater than 25. But what's more common is sort of mini spikes, kind of choppy waters. And that's exactly what happened in the late 1990s and early 2000s in that dot-com period. And it looks to be what's happening to us right now. After all, what's happening right now isn't a massive real estate debt crisis. It's basically the correction to an overvaluation in the equity markets driven by low interest rates and a reaction, quite sensible, to inflation and rising interest rates. But here's the important point. If you look at each of those spikes in the cumulative greater than 25 VIX, they correspond to periods of missing IPOs. The chart at the bottom shows rolling 1 quarter IPO capital raising over that same period of time. See those gaps in the chart? Those correspond to the blue triangles at the top of the page. And we're living through a period of choppy waters, just like the late 90s and early 2000s as well, and that's likely going to have an impact on IPO windows opening and closing, opening and closing. What we think is going to happen over the next year is something a bit less than 2000, a bit less like 2008 and 9, when the window was just shut, and a little bit more like the early 2000s when it opened and closed, and entrepreneurs will basically need to hurry and then wait. Get themselves ready, and then wait for just the right moment to get their public company out of the gates.
Over the past 90 years, the concept of GDP has become one of the most ubiquitous three-letter acronyms around the world. After Bretton Woods in 1944, it became a worldwide metric, outlasting even the gold standard. Consumers of economic news are quite literally inundated with statistics on GDP growth almost daily. Startup pitches and public company earnings presentations alike, especially from emerging markets, love to cite the GDP growth of their respective region as a selling point for prospective investors. The World Bank and the IMF, along with countless investment banks, have teams of analysts calculating historical GDP and forecasting future growth. The legendary professor Angus Maddison, who passed away in 2010 and left behind an impressive legacy of work, even calculated GDP per capita for several countries going back 2,000 years. But it is worth stepping back to ask a fundamental question. Does rising GDP lead to shareholder value creation? In which cases and under what circumstances? To try to answer this, institutional investors have segmented the world into ostensibly lower GDP growth developed markets and higher growth emerging markets, just as they divide the world into growth stocks and value stocks. But looking at high-level aggregates is often too simplistic and doesn't explain the full picture. Despite all the effort that goes into separating growth versus value stocks within the MSCI World Index of Developed Economies, their performance over long periods of time has been almost the same. And while there has been a modest difference of about 130 basis points of annual compounding between MSCI's DM versus EM indices, with EM slightly ahead, looking at aggregates at 80,000 also doesn't explain the full picture. To delve into this, I spoke with Friska Claudia, who works in Asia Partners' Jakarta office. Friska is also an investor operator, having worked at JAPFA, a Pan-Asian agricultural and food company, managing strategic projects across the company's downstream business units. She is also an alumna of McKinsey & Company's Jakarta office. She grew up on the island of Java in Indonesia and is a graduate of the University of Hong Kong. Friska, pleasure to see you. Tell me more about why you think the popular framework of lumping countries into DMs and EMs is too simplistic.
It's not that we feel the DM and EM classification is wrong per se, but rather that there seem to be a hidden set of variables that might arguably be more important in explaining why some countries' stock market do better for others over a long period of time. Let me lay out a few examples of what we mean. On this exhibit, you can see that on the left-hand side a ranked list of countries by their country equity IRR over a pretty long period of time, year 2000 to 2022. This is in US dollars. And likewise, on the right-hand side, you can see a ranked list of countries by their nominal GDP growth rate over the same period of time, also in US dollars. If higher GDP growth mechanically translated into higher equity IRR, you would expect to see that the name of the countries is in a roughly similar order, but instead you see something quite different. To pick on a country close to home to us, Vietnam has had a second fastest nominal GDP growth, but is in the bottom half of value creators. China has had the very fastest nominal growth as well, but is in the middle third of value creators. And Saudi Arabia has had 8% nominal GDP growth, but essentially has been flat for equity holders for over more than 2 decades. That's a puzzle worth solving.
Does it also go the other way around? Low growth countries that create shareholder value?
Absolutely. It's not categorical, but there are several examples of that. Consider Japan, whose nominal GDP in dollars has actually shrunk in the past 22 years, and yet its equities have yielded 4.3% annually. Or Mexico, whose equity return is roughly double its nominal GDP growth. Whatever solution there is to this puzzle has to account for that too. We came at this puzzle hoping to go one level deeper than simply saying that there's a weak correlation and leaving it at that. We were interested in trying to see if there were patterns where certain countries are more likely to have... Okay, sorry, aku salah baca tadi.
Okay, nih.
Dari sini ya. Okay. We came at this puzzle hoping to go one level deeper than simply saying there's a weak correlation and leaving it at that. We were interested in trying to see if there were patterns where certain countries more likely than not to have a higher linkage on a sustained basis and other countries a lower linkage. And did that change over time? Taking a step back, you could imagine a few different patterns that might emerge. To illustrate that, let's pick a year where that was neither the top of the cycle or the bottom, but more in the middle and far enough back in time that we can see what happened since then. We picked 2004 since the data were available for a lot of these countries for 2000 and onward. Let's say, to be able to look at these countries on an apples-to-apples basis, that we normalize each country nominal GDP to 100 in 2004, and likewise normalize their stock market index in dollar terms to 100 in year 2004 as well. Then we can see what happens as we advance the clock year by year and draw a curve that links each of the annual data points. And in situations where the data was available, we could also reverse the clock and see what happened before 2004. Just thinking from the first principles, you could imagine how the curves might progress from the year 2004 through 2022. Different trajectories, if you will. Let's start a bit out of order with Model 3, which we call fair and balanced. That means for each 1% of nominal GDP, the country's stock market index also grows 1% in dollars. That translates into a pretty much 45-degree line pointing northeast, which is the dotted gray line. Model 3 is a thick blue arrow that follows that 45-degree line. Now let's think about variations on that theme. If, for whatever reason, the stock market grows over faster than nominal GDP over a sustained period, it might be too good to be true. That's what happened to Japan leading up to the famous crash in 1989, for example. We call those too good to be true situation Model 2. And you can see the purple line tilted at by more than 45 degrees, and we call it north by northeast. On the other side, you could imagine nominal GDP is growing, but you're not seeing that reflected in the stock market. Something is out of sync. That's the green arrow, which is less than 45 degrees. Let's call that Model 4.
Could there ever be a good reason, a valid reason, why a country could be too good to be true?
We saw that some countries persistently seem, over a very long period of time, to have a slope of more than 45 degrees without major corrections. Those countries were generally ones with very successful multinationals companies who were able to draw upon global GDP as their end market, not just the domestic GDP. We called those global champions, and we designated those Model 1s. To be fair, there's a fine line between Model 1 and Model 2 that is ripe for a crash, and plenty of Model 1s have their own corrections along the way.
What is Model 5?
As we went through the process of trying to classify countries based on the trajectories of this chart, we kept finding countries that didn't just have a low conversion of GDP growth into equity value, but actually had a pattern of quite a literally circular motion. Their GDPs and stock indices would each decline and then rise again and then potentially decline. That's what's different from Model 4, where GDP seemed to march by and large rightward, though with non-proportional conversion into upward movements. We call those circular situations Model 5.
Is it safe to say that some models are better than others?
Yeah, absolutely. All else equal, you would want to be a Model 1. But only a small numbers of countries have multinationals global enough and competitive enough to do that. Next in order is being a Model 3, which is a very respectable place to be. Where you should get worried is if you fall into a Model 2 territory. We'll come back to that in the moment, but there's a reason why we have the dotted line going down. It's not much better being a Model 4. In fact, many Model 2s ends up being Model 4s, or even worse, Model 5s. The 1990s were very much Japan's lost decade after the crash in 1989.
So when you applied this approach, how did the countries fall into the different buckets?
It looks like this. Note that there's a fair amount of subjectivity, which is why we are publishing each of the trajectory in the 4th edition of our annual report. We would love to get the community's feedback on whether they'd classify the country somewhere else.
Unpackage this for me if you could. I see you still kept the EM-DM dichotomy.
Yes, but it's more as a way to highlight that the 5 models actually transcend the EM and DM buckets. That's what we hope to find, as we were a bit unsatisfied with the EM-DM framework as an explanatory variable. In fact, other than Model 1, the global champions, there are EMs and DMs in each of the other 4 models, which is a way of saying, at least to us, that what matters more is which model you are, not whether you are an EM or a DM. The second thing that comes across is that there are, even despite the market correction, several markets that strike is as too good to be true. I'm sure others will disagree, but we invite folks to see charts for themselves and form a view. I'll come back to Model 3 in a moment. And there are a lot of Model 4s, more than we would have expected. And some surprising countries fall into this bucket, many more than we would have expected given the constant barrage of headlines about the GDP growth in many of them. And perhaps most depressingly of all, we were very surprised truly by how many countries fall into Model 5, especially after the years of 2007. Sorry mas, aku agak salah baca. But yeah. And perhaps most depressingly of all, we were really surprised truly by how many countries fall into Model 5, especially in the years after 2007. It feels more like a lost 15 years than a lost decade. And while a lot of these countries are in Europe, it's not just a European dynamic. There are examples on almost every continent, both EMs and DMs. Which brings us back to Model 3. We have a special fondness and respect for these countries. They strike us as giving a fair deal to shareholders. What's striking is how few of them there are, just 8 by our count. And what makes us thrilled to be in Southeast Asia is that our region is home to a quarter of them, with several other in close proximity like Hong Kong, Taiwan, and Korea. This is a huge positive for companies in our portfolio like ShopBack, which is in 5 out of those 8 Model 3 countries, plus several others.
But surely this isn't static. Can you change models?
Absolutely. There are some countries like India, which, despite of all the headlines you read, has actually been a remarkably consistent Model 3 for quite some time. But other countries change models from time to time, not every year, but over decades. Japan is a great example of going from Model 2 to Model 4 and then back to Model 2. It really runs hot and cold. Malaysia, here in Southeast Asia, is a great example of a Model 2. Remember when they built the tallest building in the world in the mid-1990s? Which became a Model 3, which was a good news, but then slipped into a Model 4. We hope that Malaysia will one day become a Model 3, but last 12 years has been pretty consistently Model 4. 4-hour flight away from Singapore, Bangladesh went from Model 2 straight to Model 4, with not Model 3 transition in the middle. And a bit further afield, Egypt, which is one of the world's 15th largest country by population, and doesn't quite get enough attention from investors, likewise went from a Model 2 to a Model 4. There was a tantalizing period between 2008 and 2010 when it looked like a Model 3, but 3 years is probably too short of a period to make a classification.
I'm seeing a pattern here, which is that Model 2s generally don't turn out well.
That seems to be the case. Perhaps that's really the key litmus test between a Model 1 and a Model 2. So of course it's easier to see that in hindsight. But we can take that gut sense and make it a testable proposition. If you're starting to veer up above that 45-degree line, regardless of what model we think you are in, what's the risk that next year you will have a correction? In the game of golf, there's a fairway, and on the other side, there's a rough, an area of thicker and higher grass. Imagine the blue line above, which is the Model 3 textbook example, is surrounded by an increasingly challenging rough, which are the gray lines on the other side. We've chosen the ratios to be equidistant on a log-log axis. So now the question is, as a function of how far away you get from the fairway into the rough, north of the blue line, how much risk is there for a correction? Turns out, quite a bit. There's always a chance for correction, even when you're on the 45-degree line. Markets are volatile after all. But the higher you get above the line, and the further into the rough, which corresponds to moving down this page from the middle to the bottom of the page, the higher the risk that in the next calendar year, your stock market index calls. In fact, whenever you are at or above the 1.5 line, which means that the stock market level is 1.5 times the nominal GDP level, relative to both being 100 in 2004, and the stock market went up that year, you've got a greater than 40% chance that the next year is going to be a down year. It's important to note that it's not a sure thing that it will fall next year. Why not? Well, some of the countries are the very rare Model 1s whose total addressable market isn't just the whole market, it's the whole world. But more importantly, Model 2s can build up a head of steam, so to speak, for many years in a row. Remember Japan in the 1980s? The crash could have happened any time in the late 80s. It just happened to happen in 1989. Loosely speaking, once you're at 1.5 and above, and you're not a Model 1, you're definitely in the danger zone. India is a great example of seeing this in action. Each time the blue line got a bit too high, it got corrected downward. And each time it was too low, it got corrected upward. Somebody must be good at golf over there.
Can we take a look at some of the other countries? What do the elusive Model 1s look like?
Let's start with those. There's a very small number of them around the world. Denmark's a good example with a 76-degree slope since 2004 rather than the 45 degrees. For 30 years, being that far off the diagonal hasn't hurt it. Part of this may be the influence of Novo Nordisk, which is at a $310 billion market cap, is far and away the biggest public company in the country by a factor of 7x, and a very global company. Germany is a Model 1 as well. Ditto for Switzerland. It's a judgment call as to whether a 53-degree slope since 2004 is a Model 1 or Model 3, but we erred on the side of being generous and called it Model 1. Three big companies, all very global, dominate the Swiss index: Nestle, Roche, and Novartis. That's probably a part of what you're seeing here. And the United States strikes us as the Model 1 as well. 58 degrees feels far enough from 45 degrees to make that call. And to say that the US has successful multinationals is an understatement. It goes back to our bonsai tree framework, where most of the category 1 bonsais are from the USA. Remember, the Google of Thailand is Google. The Netherlands is an interesting one. For most of the time period, aside from a brief Model 2 episode in the late 1990s that sorted itself out, it's been a Model 3. But if you look at the last 7 or 8 years, there's a case to be made that with a 66-degree slope since 2004, it's a Model 1. The company that's driving that is ASML, which is by far the most valuable company in the Netherlands, at a 264 billion market cap as of this filming. Proces, which has a 165 billion market cap and includes internet companies around the world, is second, though it went public more recently. Heineken, at a 57 billion market cap, is third, and that's also a very global business. The global payments company Adyen is number 6 by market cap in the Netherlands at 46 billion, and it's still well above 2008 IPO price.
Who's a Model 2 then?
There are two clear candidates for now, Argentina and Japan. They couldn't be more different, but they are both Model 2s. Here's Japan. Again, you can see it was a Model 2 until the 1989 crash, then a Model 4, and now it's Model 2 again, and has been for quite some time. The slope here is literally 90 degrees. It's gone vertical since 2004, despite virtually no change in nominal GDP. That should worry everyone. And yes, while it has multinationals like Toyota, Sony, and SoftBank, it also has a lot of companies that link to and frankly constrained by domestic GDP. Argentina strikes us as a pretty clear Model 2 candidate as well. It was actually a Model 5 during the late 1990s and early 2000s, and then had a spectacular recovery, almost Model 3-like. But this last few years has put it far above the diagonal.
Let's shift to Model 3.
There are just 8, and to recap, a quarter of them are here in Southeast Asia, with another 4 nearby. We find that fascinating, how so many of the Model 3s are in the belt from India to Southeast Asia to Korea. The Philippines is a great example of a Model 2, turning constructively into Model 3. Doesn't get anywhere near as much credit or attention as it deserves. As is Thailand. It's another great example of a Model 2, turning constructively into Model 3. It's also one of the most active capital markets for IPO in our region, but most of it are domestically focused. As a Model 3, That's not necessarily a bad thing at all. Looking at our West, India is a model 3 as well. One day, we hope to expand our investing program to India, especially as it starts to approach the golden age. We love markets like this, where GDP turns into shareholder value. Then looking northbound, South Korea has been a solid model 3. Yes, there has been some going in circles, but the slope has been a textbook 45 degrees in angle since 2004. Here's Hong Kong, and here's Taiwan. The recent lift off from 2019 to 2021 from the 45-degree line is probably TSMC, which is by far the largest public company in Taiwan. And finally, New Zealand and Canada have been model 3s as well. Yes, Canada had its own goings in circles moment, but from 2004, the slope has been pretty close to 45 degrees.
And Model 4?
It's a long list. Let's pull out a few representative examples, some close to home and some further afield. The country that's probably the biggest surprise when we show this chart to folks is China. The stock market has been essentially flat from 1993 to 2022. Yet at the same time, the country's nominal GDP in dollars has grown by more than 30x. That is the raw data. It's worth pointing out that our understanding is that companies are based in China, but trade abroad, like Alibaba, are also included in the index. It's not just the onshore traded companies. Vietnam is another clear model 4. At least its market has grown since 2004, but not as much as its GDP has grown. The slope is just 23 degrees, coincidentally the same as China since 2004. Singapore is, likewise, a model 4. It's not that the market hasn't grown, it's that the slope has been 30 degrees rather than 45 degrees. As is Indonesia, at least in the recent year, it had a great run from 2001 to 2010 as model 3, and then something changed. We could roughly say the same thing about Malaysia. A great 15-year run after the Asian financial crisis from 1998 to 2013, and then something changed.
And finally, Model 5.
It's a long list as well. I'll share a few representative examples. We have all of them in the report on our website. This is just an off-the-cuff view, but it strikes us that Saudi Arabia goes from a Model 4 to a Model 5 based on the oil price. Something similar seemed to happen to the UAE as well. The UK, sadly, has been a textbook Model 5 over the past 15 years. And you can see something similar for Australia, so there's a case that it's more of a Model 4. Brazil gets attention from institutional investors from time to time. It's gone from a Model 2 to a Model 5 since 2007. Finland has an interesting history, going from a tech darling during Nokia years in the 1990s to a Model 5 more recently.
This is really interesting. What for you are the implications for Southeast Asia?
First and foremost, we're lucky to have 2 of the very rare Model 3 countries in our region, and to have another 4 of them in close proximity as our portfolio companies expand. Again, Shopback is a great example, with operations in 5 of the 8 Model 3 countries. While it's true that the other 4 major economies in our region are currently Model 4s, at least none of them, for now, are Model 5s. And some of them have been Model 3s in the past, which makes us curious about whether and how they might shift gears back to Model 3 in the future. And moreover, we do have an anecdotal sense that technology platforms, when run the right way, can transcend the underlying model of their country. Sea is a great example. While it operates in several Model 4 countries, as well as 3 of the Model 3 countries, that's the model we love, as a company, it's been one of the best performing public stocks over the past 5 years, taking the long view. And more broadly, that's in many ways been the lesson of China's tech sector. Against the backdrop of an underlying economy that's been Model 4 since, arguably the 1990s, China's tech sector has created extraordinary amounts of aggregate values.
In the previous chapter, we talked about what might be an overly simplistic dichotomy between EM and DM classifications. There's another dichotomy that gets a lot of airtime by institutional investors, especially when it comes to tech investing: B2B versus B2C, or as Hamlet put it, to be or not to be. But is the B2B versus B2C distinction the right way to look at emerging markets? Or, like EM and DM, is there a bit more beneath the surface? To delve into this, I spoke with Swapnil Chichani. Swapnil grew up across India and the Middle East before getting admitted to IIT Bombay, one of the flagship IIT campuses in India. He later joined Uber, where he was a key part of its growth in India. After getting his MBA at Kellogg, he moved to Singapore to work at BCG. He's now part of the Asia Partners team in Singapore. Swapnil, great to see you. What is your perspective on the B2B versus B2C question that gets so much attention in the US tech investing circles?
Thanks, Nancy. It's a question that makes complete sense given where the US is right now in terms of how its tech market has evolved, but it's actually a fairly narrow question from the standpoint of Asia. We first wrote about this in our 2021 report, our second, and talked about how the primary distinction in Asia, and in fact in almost all emerging markets worldwide, is actually between telcos and non-telcos. Then within non-telcos, the B2B versus B2C dichotomy starts to become more relevant. In terms of absolute value creation for markets like ours, the largest player for many years, even until recently, have been the telcos. And the steady rotation of shareholder value away from telcos and towards the newer TMT business models, which is represented by the green arrow above. This has been a very important theme for many emerging markets. If you're looking at it from a US lens, it's almost like you have to roll back the clock on how venture capital worked in the 1950s or 60s, well before Marble was broken up in the US and well before the software industry IPOs of the 80s. At one point in the US, Marble, or AT&T, was one of the most valuable TMT companies in the country, and indeed the world. Then came the breakup into the baby bells, and in parallel, a massive wave of new tech innovation. There are dozens of subsegments of the tech, media, telecoms, or the TMT landscape, but to simplify things, let's boil down to 8 core segments. Telcos at the 11 o'clock position, and then in clockwise fashion, hardware, semiconductors, data and data processing, IT services, software, internet and e-commerce, and traditional media, the M in the TMT. Think of these as food groups or ingredients. They're all important, but each country or region in the world has a rather different recipe for how much of each ingredient to use. We can analyze how those recipes differ. Let's start with a global mix of equity value by ingredient. Think of this as the grocery store inventory. And each country is like a different family selecting different ingredients to bring home based on their unique recipes and preferences. On a global basis, at year-end 2022, the world's TMT equity value was 10% telcos, 19% hardware, 14% semiconductors, 8% data and data processing, 21% internet and e-commerce, 5% IT services, 19% software, and 3% traditional media. That's very different from what the weightings were in 2005, and you can see how the mix of telco has fallen by 2/3 globally from 30% to 10%, while software during the same period has almost doubled from 10% to 19%. And internet e-commerce have not quite tripled from 8% to 21%. But each family gathers the ingredients for a different recipe. If we look at the ingredient mixes across different parts of the world, they over-index or under-index quite dramatically from the global mix. For example, North America under-indexes quite dramatically on telco market cap, whereas over-indexes on software and data processing. That's why we think many American institutional investors think about the B2B versus B2C distinction rather than the telco versus non-telco distinction. The telco lens was a lot less relevant after the 1984 and the baby bells. Then take a look at Western Europe. IT services is much more relevant, as is traditional media and telcos. ASML shows up in semiconductors here. China is a fascinating example. It indexes fairly closely to the global mix with 3 major differences. 1, virtually no data and data processing market cap. Recall that Ant's IPO was put on hold and China UnionPay is still privately held. relatively little software here, and a 1.9x over-indexing on consumer internet and e-commerce. South Asia is vastly different from almost every other part of the world, surprisingly so given the amount of venture capital that has gone into consumer internet companies. It under-indexes on virtually every category other than lightly over-indexing on telcos, at least for now, and massively over-indexing on IT services. TCS is the country's second largest public company at a 152 billion market cap, and Infosys is number 4 at 77 billion, which finally brings us back home to Southeast Asia. It's different from China and from India. Like China, we vastly under-index on data and data processing, but what's really remarkable is how much we over-index on telcos by 5x the global mix. We also over-index on traditional media. Now that C, Grab, and others are public, we match the global mix of consumer internet, but we are still behind China's mix of consumer internet, which gives us a lot of optimism for that sector in Southeast Asia over the coming years. What we will see in a moment is that Southeast Asia today looks remarkably like China 10 years ago, which is, in its own sort of way, a sort of time machine for that we might look like in the coming years. You can see these trends more visibly and over time by looking at each country or region in a sequence. This exhibit shows the equity value mix of North America by sector. The trends have been fairly consistent over the past 2 decades, with the mix from telcos, traditional media, and IT services continuing to fall, internet and software rising, and semiconductor and hardware modestly down. Europe feels a bit like the US, but a few decades shifted in time, with the telcos mix in 2022 where North America was in 2005. Although culturally part of the West, Australia is even more shifted in time, with telcos still 40% of the TMT market cap and a missing hardware and semiconductor sector. In contrast, as we shift to Asia, we see where a lot of that global hardware and semiconductor market cap is coming from. South Korea's mix is almost 70% hardware and semiconductors, and remarkably just 3% telcos. There's probably a link between the rapid ubiquitous broadband in Korea and competition among the triopoly of Korea Telecom, LG, and SK Telecom. Japan is a bit more than 40% hardware and semiconductors, though as we pointed out in our 2021 report, its telcos have been remarkably resilient, much more so than, let's say, Korea. Taiwan is a great example of a semiconductor specialist, and in fact, over 90% of its total market cap comes from hardware and semiconductors, with a dusting from everything else. The biggest part of that 90% is TSMC, one of the world's most valuable companies. What Taiwan is to semiconductors, India is to IT services. In fact, far from being commoditized by cloud and AI, as was occasionally feared, India's IT services mix has grown from 60% in 2005 to 69% in 2022. But look at how the internet contribution is, just 6%. This is a direct consequence, we believe, of India not yet being in the golden age of affluence. Once it approaches $4,000 of GDP per capita in 2023 dollar terms, that will grow substantially, in parallel with its IT services industries, perhaps becoming less cost competitive. The rest of the world's emerging markets fit a common theme here. Telcos slowly losing ground. This trend vastly outweighs the B2B and B2C distinction, which becomes more relevant over time. You can see this playing out in Eastern Europe, with a very impressive showing by both software and consumer internet. Ditto in Latin America, where Mercado Libre has built a classic Cat3 bonsai business, giving Amazon a run for its money. And also in Africa and MENA, though it's worth pointing out that some of this is actually indirect exposure to China through Naspers.
Where does that leave China and Southeast Asia?
There's a lot happening in China, with almost 20 billion of nominal GDP. That's a lot you can build. China is one of the world's most diversified tech ecosystems, comparable in some ways to the world as a whole, but with consumer internet over-indexed relative to global mix, and software and data processing under-indexed. Which brings us to Southeast Asia. Remember that green arrow from the beginning? The one where telcos lost market cap and non-telcos gained? That was in Southeast Asia from 2005 to 13. In fact, telcos gained market cap during that period of time. But starting in 2014, perhaps due to the ongoing telco competition or perhaps because of 4G mobile coverage starting to percolate through the region, telcos started to lose ground and non-telcos started to grow. That continued until 2022 when there was a contraction for both. In many ways, Southeast Asia looks like many of other emerging markets we just talked about. Telcos slowly in decline and consumer internet growing more recently. The big moves between 2021 and 2022 are largely linked to C's reduction in market cap from its late 2021 peak. The point that we find very interesting is that Southeast Asia's mix in 2022 looks remarkably like China's in 2012. There is no guarantee that they will end up converging over time, but based on the periodic table that Oliver shared, there is a lot of evidence to suggest that Southeast Asia will look more and more like China over time, at least in terms of mix. And a major part of that, we think, could be semiconductors, which we will talk about next.
Well, we've left 5 shorter topics for this final section in the spirit of stirring the pot a bit. First, Swapnil alluded to the opportunity for semiconductors. How do you see that playing out in Southeast Asia?
Swapnil makes a very insightful point. If you look at the journey of the semiconductor industry over the past 20 years, there have been 2 things happening in parallel. One a little bit more visible and one a little bit more behind the scenes. Very visibly, the productivity and capability of semiconductors continues to follow Moore's law. It's breathtakingly impressive to see the ongoing miniaturization of semiconductors and their ongoing efficiency and productivity. A little bit more subtle is the global shift in where semiconductors are being manufactured and where they're being exported from. Take a look at the right-hand side of this chart. It's no surprise that China has become a very successful participant in the global semi-industry. In fact, over the past roughly 20 years, their exports have grown at 16% annually. They are today the world's largest exporter of semiconductors on a global basis. But what's a little bit less known is that if you were to add up all of the countries of Southeast Asia together, they would collectively be the world's 2nd largest exporter of semiconductors. Now, these may not be the absolutely nifty, latest cutting-edge stuff that TSMC is making in Taipei, but they're very meaningful in aggregate dollar terms, and they've grown, whereas many other parts of the world have actually seen their exports shrink, like the US. Malaysia, Singapore, Vietnam, Thailand, Philippines, in particular, have been important growth areas for semiconductors, and we especially want to call out Vietnam at 41% annually over 20 years. That is one of the single largest growth rates and single biggest success stories in the world for semiconductors. The commercial ties between Vietnam and the rest of North and East Asia, predecessors of Vietnam in the semiconductor industry, are deepening and growing in a very, very interesting way. Now, here's the interesting dilemma from an investor perspective. Although Southeast Asia is the 2nd largest aggregate exporter of semiconductors, there's only about 30 plus semiconductor companies that are publicly traded in Southeast Asia. The vast majority of the world's public semi-companies are in Taiwan, Korea, China, the US, and Japan. So what Southeast Asia has sort of become is in effect, the factory for these 5 countries here in the region. And the publicly traded companies and the opcos and holdcos, if you will, are actually sitting overseas. The biggest question that we have in our mind is, will we see the genesis, will we see the creation of indigenously headquartered companies here in Southeast Asia to capitalize on the dramatic growth of this industry and the geopolitical realignments? To that end, we take a cue from Korea. Now, this chart has a little bit of survivorship bias, but nonetheless, it makes an important point. If you look at every public company in Korea today and categorize them by industry, and you look at the date that they went public, again, leaving out companies that have liquidated or been bought over time, delisted, textiles, followed by auto, followed by electronics in terms of the number of public companies Korea has produced. We think that every economy of a certain size that has a thriving textile industry has the right to play in getting into automobile exports, and therefore then has the right to play in terms of getting into semiconductors and electronics. You saw that happening certainly in America, certainly in Japan, certainly in Korea, certainly in China. It happened 2 out of 3 in Taiwan, where there was a textile industry and now there's a thriving semiconductor industry, as Swapnil shared. Isn't an auto industry per se. And we think that the next one to keep a very close eye again is Vietnam, and perhaps Malaysia and a few others in Southeast Asia. Something to keep a close eye on.
When Oliver talked about talent dynamics and graduates from the top universities in China, India, and Korea, it was interesting that you didn't mention talents coming in from the US and Australia, which are so well known for their universities.
This is a great question, Nancy. You're absolutely right. One of the things that we have started to track is maybe a partial answer to your question. We're really curious to find data on how many students from Asia and Southeast Asia specifically are going to the US and going to Australia for higher education and then coming back, what's often called the sea turtles. And we would summarize our view in the next 10 years in a single statement. Keep an eye on the Vietnamese sea turtles. Why do we say that? Well, if you look at the number of students that go to America for higher education, college and beyond, masters and whatnot, it's been very interesting to see the trends. China has sent an absolutely enormous number of students to America, as has India, as has, in relative terms, Southeast Asia. But interestingly, there are waves. China's wave, we think, has likely peaked in 2020. India's wave hasn't peaked yet. Southeast Asia's wave, TBD, but there was a temporary peak in 2018. Korea peaked many years ago. Taiwan, well in the 1990s, and Japan in 2000. But if we unpackage Southeast Asia into its constituent countries, the Vietnamese students going from Vietnam to America have grown at a breathtaking rate. This chart, like the previous one, is on a logarithmic y-axis. You'd see even more dramatic rise on a linear axis. And we don't think that the Vietnamese students have yet peaked going to America. The dip you see over the last few years is largely COVID and travel related. We would very much want to watch this space, and I think a new generation of founders will increasingly be coming back to Southeast Asia from Vietnam, but with an American education. And by the way, many folks that live in Southeast Asia will say, America's nice, but actually Australia is closer and a bit more affordable in some cases. That's why we look at the Australian data as well. You see the data here for most of Asia in terms of China, India, Southeast Asia, and so on and so forth. And again, what's very interesting to see is that Vietnam is the single largest contributor of students going to Australia for higher education as well. And we think that trend will only continue over the years to come.
One of the most interesting takeaways from the talent mapping was that massive surge in hiring by ByteDance. They've become the new B in the BAT acronym.
You're very right, Nancy. BAT, which we think originated sometime in the mid-2010s, at least that's the first reference we can find for it online, used to be Baidu, Alibaba, Tencent, and now, of course, people think that the B ought to be ByteDance. One of the things that we would likewise emphasize, just like we want to watch the Vietnamese sea turtles, we want to keep an eye on the ByteDance alumni in Southeast Asia for two reasons. Number one, there are going to be a lot of them. There are currently 10,000 ByteDance employees in Southeast Asia, according to LinkedIn. Only about 28% of them have left. Now, maybe it's a bit apples to oranges because maybe there were fewer people when those people left, but in general, there's a lot more alumni still to come out of ByteDance in Southeast Asia the next couple of years. But the second reason is also very interesting. They've come from some really interesting alma maters before ByteDance. Sea, Grab, Lazada, software companies, global tech majors, they have entered ByteDance with a terrific skill set. They will continue to develop a terrific skill set, including in e-commerce, where ByteDance has done a fantastic job in Southeast Asian e-commerce. And we can't wait to see what the ByteDance alums do over the next 5 or 10 years. We think it'll actually end up becoming one of the larger clusters of founders, just like the Zalora Mafia we talked about earlier in today's film.
We spent a lot of time talking about IPOs, but for many private equity firms around the world, strategic sales make up much of their liquidity. How will that play out in Southeast Asia in the next decade?
You're absolutely right that we love taking companies public, in part because when you aim for an IPO, it sets up a very high bar in terms of governance and systems, internal rigor. But of course, as one of our LPs likes to say, the most convincing SIM, confidential information memo for a company, is often its S1 or F1 filing with the SEC. So there's many, many opportunities over the coming years for companies in our portfolio and others to consider being part of a larger company. The important question is not whether people want to sell. The important question is whether people want to buy. And if you think about the journey of companies getting sold in Southeast Asia, it's taken a very interesting turn over the last 20 or so odd years. Take a look at this chart for a second. What you're looking at on the y-axis is the mix of how much M&A volume within emerging Asia is in China, Korea, South Asia, Southeast Asia, or Taiwan. And on the x-axis, you see 1998 until 2012. And this includes not just cross-border M&A, but within border M&A. A Southeast Asian company buying another Southeast Asian company, or a Korean company buying a company in China. All situations. And what you see is that over the this period of time, China was about 32% of the mix by dollars, and Southeast Asia was about 25% of the mix. And take this as sort of more directional. The data set isn't perfect, certainly not going this far back. But look what a difference the last roughly decade made. China grew to well over 50%, and Southeast Asia fell to 12%. You can see the incredible strategic importance of China and the priority that China escalated to over the past 10 years, and perhaps the receding of Southeast Asia as a strategic priority over this period of time. We are convinced that these two dotted lines will compress closer to each other. They may not flip over each other because China's economy is massive and domestic M&A is very, very vibrant. But these two dotted lines will certainly squeeze closer together again as they did from 98 to 2012. Now, this includes domestic to domestic as well as foreign to domestic target. What if we just look at cross-border M&A? That's something worth thinking a little bit about, because cross-border M&A is when a buyer somewhere else in the world decides that they love a certain region and would love to partner with and do business with an existing team, with an existing franchise, an existing distribution network, and to put two and two together to make something more than four. If you look at 1998 to 2012, Southeast Asia was actually more than China in terms of inbound cross-border M&A. M&A into China, into Korea, into South Asia, into Southeast Asia in blue, and into Taiwan. However, in the 10 years that continued, it flipped. China became higher and Southeast Asia became lower. Again, we think that these two curves will move closer together again, and there's every possibility, given the new geopolitical realities, that Southeast Asia becomes one of the most important parts of Asia for global companies to buy product. If you will, buy existing companies on the ground with networks, relationship, Category 3 bonsai network effects that are regional and hard to replicate. We would again say, watch this space. We think it's going to be a very interesting time for investors in local South Asian companies to seek liquidity by selling to global companies desirous of market access here in Southeast Asia in the next decade.
From time to time, one comes across articles talking about how many major global companies were actually founded during times of economic crisis. GE was founded around the time of the Panic of 1893, and GM right after the Panic of 1907. Disney was founded in the years before the Great Depression, and Microsoft in 1975, in the midst of the 1970s stagflation.
It's really true. You come across these articles all the time about how companies formed during years of challenge and hardship often prospered. It's sort of like the old joke that, when we were young, we ate dirt, and you youngins have it all easy. And there's some truth to that. Things were harder in the past. One of the things that we stumbled upon is something that is so curious that we can't help but want to share it and talk about it a little bit. And we were genuinely surprised to see the behavior you're about to see. If you look at the number of American students, and by the way, we'll show Southeast Asia in a second, that graduated with a degree in computer science, it's been upwards and to the right, but part of that's driven by population. And the number of students that go to college. If you simply look at, though, the percentage of graduates of U.S. universities that graduated with a degree in computer science, it has basically oscillated almost like a trigonometric sine wave on a roughly 17-year cycle. Now, the cycle begins in the 1970s because computer science wasn't even a discipline until then. That's when universities started actually formalizing how to teach people how to program and learn computer science. But you see peaks in the 1980s, another peak in the early 2000s, and another peak today. We were really curious. What makes a major for undergraduates so cyclical on such a predictable, almost eerily cyclical basis? Well, it turns out that if you were to overlay the chart of graduates by graduation year with something which probably requires a little bit of explanation, there's a very strong fit. Imagine that you're driving up in your family station wagon to your undergraduate dormitory, you're excited, you're pumped, you haven't chosen your major yet. And as you're sitting in the back of the car, mom and dad are talking all about how well their portfolio has done. They owned Iomega in the 1990s or Yahoo. Now more recently they owned Snowflake. Perhaps in the 1980s they owned Apple or Microsoft or whatever was public back then, Intel. You might be influenced by what you heard around you. You might be influenced by the perception of value creation and financial stability for your family. It turns out that if you look at the cycle of graduating college students in America by major for computer science and overlay that with how the NASDAQ had done in the years leading up to when you were driving up to school to pick your first year major, there's a wonderful hand-in-glove fit. It's not a perfect correlation, but it's pretty close. And again, you have to shift it by 4 years because computer science is a prerequisite heavy major. You can't make up your mind to be a computer scientist the last week of your final year of school. It gets planned early on. You lock yourselves in. Turns out the same thing is broadly true in Southeast Asia as well. We found data for the National University of Singapore, one of the flagship universities of our region, and by and large it tends to follow a roughly analogous pattern. This is super interesting for us. It lets us do two things. It lets us have a view on where that cycle might take us for the next 17 years. But I want to go back to Nancy, your wonderful point about General Motors and GE and even Disney, which was founded 6 years before the 1929 crash. Is there something unique about the companies that get founded when the CS majors are at an all-time high or at an all-time low? To test that hypothesis, we found a list of all of the world's companies in tech that have at least a $20 billion market cap. We stripped out the telcos, many of whom were founded many years ago, often out of state monopolies on a global basis, and instead focused on the companies that were founded in 1971 or later. And what you find is fascinating. A remarkable number of today's $20 billion plus publicly traded global technology companies were founded when computer science graduates were in their own little recession. Not an economic recession, not an employment recession per se, although there might be some linkages. A computer science graduate recession. Take a look at the data. 64% of all of those companies founded since 1971 or so, with a $20 billion value or greater today, were founded during what we call the contrarian trough, when people weren't getting as many degrees in computer science. Only 17% were in that period stretching up to and including the peak. And if you look at it by value, and not just by the number, although they're all very valuable companies, it's even more pronounced. 78% were founded during contrarian troughs, which means we can combine both of these ideas. If there really is a 17-year cycle, which is propagated by the cycle of the capital markets, in fact, propagated by tech bubbles to a certain extent, then we could imagine that if the rough periodicity continues over the next few decades, there's probably going to be another peak sometime in the late 2030s, which means that as we think about the next trough, it's likely going to be somewhere unscientifically between 2024 and 2032, which means that the founders of 2024 to 2032 will change the world. We can't wait to meet them. And our sincere hope is that we'll have a bit more than our fair share of them right here at home in Southeast Asia. Nancy, thank you so much.
Personally, I can't wait to meet the class of 2024 to 2032, although it does make me feel a bit old. And based on what we've talked about today, I think there's objectively a very good chance that many of them will be based in Southeast Asia. With that, we'll bring our data documentary to a close. If any of these ideas resonated with you, please do reach out to any of us. We'd love your feedback. Thank you for your time and have a happy and healthy 2023.